featuring credit rating, program issuing calendar by the banks, publication of offer documents, and admission of the securities to the Securities Depository for trading. This should be, in my view, the minimum requirement that should qualify bank securities for pension fund investing. As you can see from the agenda for this conference, this year's conference promises to be thought-provoking. We start with a presentation on the Ghanaian economy outlook, to be followed by our keynote speaker, Dr. Priscilla Chumesi Bafo, who will address the topic of high interest rates in Ghana, what policy makers must do. My colleague Nana Boama, who is the president of the CFA Society Ghana, will speak on strategic asset allocation in view of the new investment guidelines MPRA has published. And of course, as has become the feature of this conference, we also have a stimulating panel discussion at the end, and I believe all of you will not want to miss it. And lastly, Mr. Hayford Atakrufi, the Chief Executive of the National Pensions Regulatory Authority, will end proceedings with an inspiring closing remarks. Ladies and gentlemen, join me to appreciate our speakers for agreeing to share their knowledge and their thoughts with us. To you, our cherished participants, thanks for joining this webinar. Let me also recognize the tireless efforts of the team at Axis and the CFA Society for putting this event together. Do enjoy the conference. Thank you very much.
Thank you very much, Afai. So, with the tone set for our conference by our Chief Executive Officer, Mr. Fiduciary, we will begin the discussion here at the 4th edition of the Pension Strategy Conference. Ladies and gentlemen, we noticed that some of you have started putting up questions, and we encourage that to keep going. And so if you have any question, now that we are about to begin our presentations, we would kindly request that you type it in the Q&A session, and then our speakers would respond to it. Like Afia has highlighted, we will take 3 presentations or 2 presentations, and then we will have a panel discussion. And so as and when the presentations are going on, if you do have any question with regard to a specific presenter, you can kindly put it up, and then we would let the presenter speak to it after the presentation. Our first presentation to set the tone for the discussion will be on the Ghanaian economy. The topic for the presentation is Axis's economic outlook for the year 2020. This will be done by the chief strategist here at Axis Pension. He's a man who has over a decade experience in financial and capital market. He's responsible also for asset allocation for the Axis schemes here. Please help me, ladies and gentlemen, welcome Mr. Carl Ogran. A round of applause for him, please.
Thank you, Jeff. And good morning to everyone for sharing your morning with us today. So as every year, when I take the economic and investment survey, and it has become an integral part of the year for us because it gives us insights into the base expectations from financial market participants on their views on macroeconomic perspective and its consequential implication on asset prices. And we are always glad to share the outcome of these surveys with you. And let me just add that the full copy of the results are made available on the website. But for the purpose of this presentation, we will group the outcome into 3 broad themes. We'll start off with the macroeconomic section, And then we would move on to the implications on the macro on asset prices. And then we will talk about the implications of the macros on the real economy. So those are the three broad themes that we would discuss today, but you can always have access to reports via our online for further information on other themes that we took. So we'll get straight off with it. The economists that we polled forecasted 2022 macroeconomic growth to come in at 5%, the plus or minus 50 basis points, and broadly in line with government's target for 2022 at 5.8%. Key tailwinds that they shared that would promote growth include the opening up of key sectors that went kind of low during the COVID situation, including aviation, hospitality, and trade. Also, other additional factors that are going to drive growth for the year include the resumption of global growth opportunities as well as sub-regional growth opportunities. But with opportunities come risk, and some of the risks that the economists expect us to face during the coming year include COVID-19 as it continues to linger around and the way it continues to mutate. Additional headwinds that the economy could face include the debt levels, commodity price shocks, as well as tight capital market conditions. But for the year 2021, we see that the economy continued to rebound strongly after the lull in COVID. And you can see that the agriculture sector continues to remain resilient, growing by 9% for the year. And then the services sector continues to also recover after going through a negative quarters of negative growth. It recorded a 13.4% growth for the year. And the industrial sector continues to be the hardest hit sector, growing by a negative 2%. So we went further to poll in from our economists what they expect from the fiscal deficit perspective. And we asked them, will government meet its deficit for the year? And surprisingly, 94% indicated that they do not expect government to meet its deficit targets for the year. And the deficit has become one of the most talked about subjects over the courses of the past few months. And the reasons they give for this is primarily because they believe that government's revenue target is overly ambitious, and also the structural nature of the Ghanaian economy. If you look at interest payments as well as compensation, they make up for a huge chunk of government's expenditure, and those are sticky expenditures that are very difficult to cut. And the present debt situation also poses a challenge to the fiscal deficit position. Now, this is a very interesting chart. If you zone in on the middle two graphs, you can see that over the past few years, total revenue has been in a comfortable lead versus interest payment and compensation. But over the past year and over the past 2 years, you can see that gap kind of narrowing and being very close to one another. But for some reason, the managers of the economy expect that the revenue gap will widen in 2022. And I guess that is why many people perceive that their target for the year may be overly ambitious. Over the past 5 years, from 2017, total revenue has grown by a compounded annual growth rate of 13%. And the forecast from the current budget is for us to grow revenues at 48%. Total expenditure has grown by a compound annual growth rate of 21%. And the budget suggests that it was going to grow by 25%, broadly in line. And if you look at interest payment and compensation, since 2017, we've grown by a compound annual growth rate of 21%. And the managers are forecasting it to grow by 12%. And so these sort of suggest that the expectations may be a bit too ambitious, and that is why we may fail to meet the deficit target. Now you can see on this graph that expenditure growth has grown, outpaced revenue growth for the most part of the year. And that again suggests that we may be in a difficult place in trying to generate the required revenue to manage the economy going forward. In 2021, the official target for the deficit is at negative 12.1, including energy sector related debts. And then in 2022, the official target from the managers of the economy is for the deficit to be negative 7.4. Now, how is the deficit going to be financed? The expectation is for it to be financed 86% domestically, as well as 14% external. But if you take a look at how our bonds are trading currently, or how our international bonds are trading, Ghana has more or less been shut out from the international market. And so the 14% may be difficult to achieve. And that also raises its own questions for the Ghanaian economy. But all in all, respondents believe that, and so this was done in 2021, believe that the debt is unsustainable and the ratings downgrade is imminent. And it's funny reading them now, because the economists perceive that in the year 2022, there may be a ratings downgrade. But funny enough, if you go into the document, you realize that for those who believe that there was going to be a downgrade, the expectation was for the downgrade to occur somewhere second half of the year into the final quarters of the year. But we know in economics, things can change very rapidly, and then the ratings downgrade came in much sooner. So I entreat all of you to have a copy of that report. There's a lot of good insights there that you would see. Additional points about the debt sustainability include the fact that the higher interest rates that we are beginning to experience will also feed into the debt situation. And I guess on a brighter spot, those who believe that even though there's a high risk of debt, the external reserves are strong enough to sort of contain any immediate shocks. On this graph, you can see how the debt position has grown over the years. From 2017, the total debt has grown from 142.6 billion to about 344 billion, and it has grown by a compound annual growth rate of about 25% since 2017. From a 52.2% of total debt to GDP, total debt to GDP now stands at 77.8%. And all in all, interest payments split between domestic financing and then external remains fairly stable at between 80% going towards domestic servicing, as well as 20% going towards external servicing. With regards to inflation, expectation was that as a fair split between what will happen in 2022, but all in all, 56% believe that the government will exceed its inflation target for the year, whereas 44% believe that the government will be within its target for the year. With regards to the stance regarding the monetary policy rate, there was a fair balance between the hawks and then the neutrals. No one believes that the policy rate will be reduced in 2022, with 46% believing that the policy rate should, 44 believing that the policy rate should be high, where 56% believe that it would remain neutral. The key points include global inflation pressures, as well as increase in commodity prices and its impact on the local economy. We've all seen what's happening to fuel and its feed-through impact on local inflation rates. The hawkish policy stance by the global central banks also has a negative impact on our economy, and they may necessitate upward increase in rates. All in all, responding to a fairly balance between a hawkish policy stance and a neutral one, as the MPC navigates its price stability, its mandates between price stability and growth. So since 2016, we've seen the policy rate and the inflation kind of trend downwards. But in the last quarter of 2021, we've seen that trajectory kind of change dramatically because of increase in inflation pressures. That has forced not only local central banks to increase rates, but foreign central banks as well have begun to increase their rates. Now on the cedi, I don't know who it was that mentioned that some things in life are constant, including death and tax. But I think from a Ghana perspective, the depreciation of the Ghana cedi will also remain a constant. If you look at the graph closely, the last 30 years, the cedi has lost on average 27%. And the last 20 years is lost 11%. In the last 10 years, it's lost 13%. In the last 5 years, it's lost 7%. And on a year-to-date perspective, as at February, it's down close to 7%. So the question is, which cycle of depreciation are you going to meet? So what does that mean for the fixed income market? The response is for short-term interest rates to go up 71%, believing that interest rates will increase in the short term, whereas 29% will remain neutral. What will drive short-term interest rates primarily include the inflation pressures that we currently are witnessing, as well as government need to raise additional source of financing, given that it has been also shut out from the international capital markets. However, increased appetite for government bills may cap a potential rise in yield. But the question is, for how long will that remain, especially given that real returns on short-term bills are now negative, meaning that you're actually losing money investing in 91-day government paper. On the longer end of the yield curve, respondents believe that rates will remain, 41% believe that rates will remain neutral, whereas 47% believe that rates will increase and 12% believe that rates will decrease. What will necessitate these movements? For those who expect rates to go up, rates are going to go up because global central banks are beginning to hike their policy rate as well. And that has implications for emerging and frontier economies as investors begin to sell local paper. Also, government's tight financing needs will also mean that it may have to offer higher yields in order to raise additional source of capital. On this graph, you can see how structurally increased liquidity into the market has sort of helped yields be trade bound. But in 2022, we saw that level of liquidity kind of dip slightly. All of these will have serious implications for the capital market. Now looking at how spreads behaved over the last year, there was a mixed performance along the curve. On the short end of the yield curve, rates, the spreads kind of declined from 2020 levels to 2021 levels. So if you look at the 91 and the 182, there was some slight reduction in spreads. But on the longer end of the yield curve as well, we witnessed some spread reduction. But in the belly of the curve, between the 2-year and the 3-year, we witnessed an increase in spreads of about 130 basis points and 140 basis points respectively. Now, this chart is even more interesting because it shows that in the final quarters or in the final few months of the years of last year, things went south, for lack of a better phrase, where spreads across the curve all increased dramatically. The 2-year was up close to 272 basis points, whereas the 3-year spread was up 232 basis points, all in the final few months of last year. And there was an average of 203 basis points increase across the 2 to 20-year curve. Now, the question which I hope the panelists may answer is, what happened in the last few months of last year that necessitated the wide spreads in our government's paper. Now, foreign investors' holdings of outstanding debt also decreased along the same period, from a peak in August, decreased dramatically in December, also along the same period. The question is, what necessitated the decline in holdings? And this graph shows how our Eurobonds traded during the year. And you notice that during the same period as well, the Eurobonds lost most of its value for the year. So something happened, and the question is, what happened? And I'm hopeful that the panelists during the discussion will touch on these points more broadly. On the equity markets, an interesting outcome. Majority of participants believe that the equity markets will maintain its momentum in 2022. 72% believe that. And what's going to drive the equity market is valuation levels are cheap. From financial market perspective, if you look at where the market is trading, there's so much opportunity to earn some healthy returns. And also the new guidelines that sort of allows or promotes pension funds to enhance their allocation to the equity market may drive some liquidity into that space, and that ultimately can help the equity market raise its level structurally. Now, if you look at the graph that depicts the valuation of the Ghana Stock Exchange from a multiples perspective, including the financial sector of the index, you can see that it's at one of its lowest points it's been. Now, the Buffett indicator, which suggests that the market cap to GDP should be somewhere above 50% for an economy. Now, if you look at Ghana's ratio, you can see that it has consistently declined from 2012 and is now at 14%. I mean, granted, you may say that there hasn't been enough listings on the market, and that is why. But then it also allows us to ask the question, especially from a regulator's point of view, as to what are the initiatives that are going to be put in place to sort of enhance equity participation in the broader market. Now, to give some context, looking at how other regions fare, in Botswana, for example, the ratio is at 20%. In Morocco, it's at 53%. In more developed markets, they are above 100 in some cases. If you look at Ghana and then our forever brothers, Nigeria, we are down there at 13%. We seem to do everything similarly between us and Nigeria. So how is this going to impact strategic asset allocation? So we kind of summarize the views from respondents. So the equity market, the view is to be a bit bullish, and the reason being earnings are increasing. There's a compression in real returns in the fixed income space. And there's a potential for enhanced liquidity into the market as a result of regulation by the National Pension Regulatory Authority. On the government local yield bonds, for those who are income seeking, the local bonds, especially on the longer term, still offer some healthy returns for income-seeking investors. So ultimately, you should have some exposure. But in terms of cash, and given where we are in an inflation cycle, you know what they say, once there's inflation, cash is trash. So do away with cash and be invested. Otherwise, you are indeed losing value on your hard-earned money. Now, Eurobonds, we look at it favorably. Probably the highlight of from a macro asset perspective, because you can actually earn dollar return by investing, if you can, in a Eurobond instrument. And so it offers ultimately a good source of diversifier. And if you look at where the Eurobonds are trading currently at this moment, probably the best times to have exposure into that asset class. Corporate bonds are also ideal for income-seeking investors, but consider the structure of the market where there is not so much activity in terms of issuances. We remain neutral from that perspective. Fixed deposits continue to offer uncompetitive returns, especially compared to inflation, and on account of the fact that inflation, the upside risk to inflation continues to be on the upside. From a local government statutory agency perspective, we tend to see a healthy risk-adjusted return, especially given that they are wrapped sometimes in some form of government security as well. For those who can gain exposure to commodity-like instruments, we are advised to consider, because you can actually earn foreign currency return by gaining exposure into that asset class, and it offers a healthy source of diversification. I'm sure during the strategic asset allocation presentation, more light to be thrown on this. So now, what are the implications of all these numbers on the real economy? Sometimes we tend to get lost in the detail. The Statistical Service recently came out, and from its most recent survey, pointed that the unemployment rate in Ghana is at 13.4%, the highest it's been on record. Whilst the unemployment rate between the ages of 15 to 24 is at 32.8%. And now this age group also happens to be where majority of the population falls. Inflation now at a 4-year high, and higher since the rebase, at close to 14% at 13.9%. Now, to give some context, in other parts of the region, especially in the northern parts of Africa, where the youth began to demand for strong accountability in terms of management of the economy, they had unemployment levels that was lower than this. Now, the same factors begin to play out, where inflation begins to go up, and it is at the point where it is now de-anchored. I don't think anyone gets pleasure from raising these statistics, but we can also hide from the data that something needs to be done. The things are not looking as ideal as we may want them to be. From a healthcare perspective, 1,000 patients to a doctor. So imagine the quality of healthcare the average Ghanaian is receiving out there. For a nation that wants to enhance diversity, unemployment among females higher at 15.5%, while the males at 11.6%. In terms of which sectors contribute to Ghana's employment, the services sector remains high at 53.3%. And I guess given the situation that has happened with COVID, we can see why these numbers do matter in terms of a policy perspective. Industry employs at least at 13.7%, and for a nation that wants to drive on the back of industrial production. These are some of the policy initiatives that we have to look at in order to move the country to where we want to be. And on that note, I'll say thank you.
Please don't go yet. I'm not sure if you have some time to take a question or two, a couple of questions for you. But what I'm going to do is I'm going to take somebody's on a lighter note, just to put it in perspective. There's a comment from George Owusu, and we wait for Carl to catch some breath, and then we would put a few questions to him. The rest of the questions we would have him respond to during the course of the conference. So first of all, George is saying that we should make the slides available. So I'm sure that we will put the slides up on our website page, and then you can download it. Isaac Mante is saying that the jargons are too much. The jargons are too much. So how will you address all that you've said, maybe in simple language, so that we can all address? But the main question I wanted you to focus your attention on is from Edem Boni. Edem Boni is saying that at the current rate of this depreciation, is it better to hold your savings in US dollars or in a fund, given that even with a compound interest? It is obvious that the cedi will weaken even further. And he's added a comment to say that even at a conservative estimate, puts it at 10 to 12 cedis to the dollar in 10 years. So maybe the main question I want you to address is that, does it make any sense to put your money in a fund as opposed to holding a dollar? In simple language, Adam.
Thank you, Jeff, and thank you, Adam, for the question. Indeed, it's a very good question. Now, it depends which kind of fund you would want to invest in. What we have seen from the past data is that the cedi assets have tended to offer very good returns. And so once you've remained invested, especially on higher yielding local assets, over a period of time, you have sought to perform, you've sought to earn return that has sort of matched the depreciation of the local currency. And so I guess the main point is you have to be invested, because leaving your money in cash is not a good alternative.
Thank you very much, ladies and gentlemen. Please let's put our hands together for Mr. Carl Okran. Mr. Okran is the chief strategist here at Access Pension, and we see a lot of your questions coming in from Francisca, from Kwabena Owusu-Entry, from Nanajwa Efriye. We'll respond to them in due course. So please keep your questions coming in. The next presentation is actually our keynote presenter. Our keynote presenter would be speaking to addressing high interest rates in Ghana. And I think it's something that Carl mentioned slightly. Our presenter holds a PhD in economics from the University of Economics at the University of Nottingham, UK. She also has a BA in economics from the University of Ghana. She's currently a senior lecturer in economics at the Economics Department, University of Ghana. She has research interest in the areas of education and labor market, enterprise development, and of course, structural transformation. Ladies and gentlemen, I'm happy to invite to present on addressing high interest rates in Ghana, Dr. Priscilla Chumesi Bafo. Please let's put our hands together for her even as she comes.
Thank you very much, Jeff, and good morning. Good morning, everyone. I am happy to be here, and I'd like to say thank you to Azos Pensions Fund for the opportunity to share my thoughts on the topic I was given, which is addressing high inflation in Ghana. What are the policy options? Indeed, I mean, sitting through Carl's presentation, I thought he had virtually done my job, but I will go on nonetheless. The areas that he has already touched on, I will touch on briefly, but I hope that at the end of the day, I'll be able to make some justifications and make important policy recommendations that could help improve the interest rate environment in the country. So in terms of my presentation, the outline is, I'll touch briefly on the structure of the Ghanaian economy. Carl has done extensive work on that. The state of the economy, looking at the monetary and fiscal performance. Why is this important? Because it feeds into interest rates. I'll look at pensions, investment profile in Ghana. Why are interest rates high in Ghana? What are the drivers, policy options, and then I will conclude. So structurally, the Ghanaian economy from historical perspective has been agrarian. And when you look at the contribution of GDP for the various sectors, you see that in the 70s and 80s, agriculture dominated GDP contribution. And this was followed by service and industry. So this is basically looking at a number of decades ago, how the structure of the Ghanaian economy was, and agric-dominated GDP. In terms of the performance, we see that contribution of sectors to GDP, it is evident that the Ghanaian economy has transformed. We have transformed from an agrarian base to an economy where now service is the leading contributor of GDP. And for a developing country, that is something that we talk a lot about. For us to go back to basics and perhaps look at our strategy towards industrialization. Like Carl indicated, unemployment is increasingly becoming a challenge in the country. And the reason is that the economy is transforming away from agriculture, which is rightfully so, but we are not moving into the very important middle, which is the industrial sector, which creates the large numbers of jobs that are required. So the economy has transformed. Service is the leading sector, but we still rely on primary commodity exports with gold and cocoa as principal export items. Recent oil finds makes Ghana an exporter of petroleum, which also feeds into, helps us with our foreign exchange earnings. But that is how the structure has been. In terms of growth performance of the Ghanaian economy, we know that when you look at the trends, plotting GDP growth for Ghana against all African countries, Africa as a whole, you see that Ghana consistently since 2008 has performed better than the African average. Even with the onset of COVID, we find that Africa grew by minus 2.02 in 2020, but Ghana grew by 0.4. So even in the midst of a pandemic, Ghana did better than the African average, which is something that is quite telling when you come to look at interest rates in the country. The story does not seem to translate there, and the issue is why. Average GDP growth prior to COVID pandemic between 2017 and 2019 was 7%. So the issue is maybe, but for COVID, some of the doom and gloom on the economy might have been different. The story might have been different. In terms of monetary performance, we see that interest rates is on the ascendancy lately. For some time, Ghana had consistently managed a single-digit inflation rate, which was great. But we see that until the onset, the incidence of COVID pandemic, which is in March 2020, we find that immediately after that inflation rate, around the time we found panic buying, people stocking, and all the pressure on the currency and all that fed into the inflation rates. Some stability was introduced, but when you look here, you find that we're able to manage inflation very well in March 2021 till around August 2021, and then the pressures, and you find that inflation rates went up. Inflation as of December 2021 was 12% compared to 10% in the same period in 2020. When it comes to the policy rates, we've seen that consistently it has trended downwards. And this is something that is great when we want to control interest rate to encourage investment into productive sectors of the economy. We expect that the interest rate would come down, and policy rate is a key determinant. Policy rate as of January 2022 is 14.5%. So with regards to monetary performance between July and December 2021, a number of key indicators that I sought to see what the relationship is in terms of giving us some crude relationship between interest rates and all other monetary indicators. So the emphasis is on the average commercial bank lending rates. And when you see the lending rate is significantly higher than all the monetary indicators, and I mean, rightfully so. So we have the policy rates between July to December. It's been inching up slightly to contain inflationary pressures lately. When you look at Treasury bill interest rates equivalent percentage, not much has happened. It's been contained in terms of how much government is borrowing on the domestic markets. The Ghana reference rates, which was a great idea to try to sort of control the spread of interest rates, it does not seem to have lived up to expectations in terms of controlling interest rates on the markets. And when you look at inflation, food inflation, non-food inflation, headline inflation, they all have a similar pattern. But when you look at the last one, which is a green bar, you find that all of them are inching up. As of December 2021, all of them were on the ascendancy, and that explains the increase in the inflation rates that we have seen in recent times. Commercial bank lending rate, as I indicated, is very high, which is an indication, clearly tells that interest rates are very high, above 20% in Ghana. So on the fiscal side, which also feeds into determination of interest rates in terms of government borrowing on the domestic markets, we find that we plot a number of indicators. Domestic expenditure is the green bar. We have domestic revenue, which is the red, and then the budget balance. Clearly, we find that expenditure consistently outperform revenue. So, revenue mobilization base of the economy remains weak. There is consistent high domestic expenditure, and that explains the high budget deficits. And so we know that in 2018, for example, the passage of the Fiscal Responsibility Act was to a large extent control government spending and keep deficits within a band of 5% of GDP. But the onset of COVID clearly threw all these plans out of gear. When you look at the budget for 2022, you see that there is a conscious effort to come back to the fiscal responsibility level, but that is something we are yet to see. So because of the constant domestic budget deficits, we see that government debt has ramped up in recent times. And when you take a historical perspective, we see that prior to HEPIC debt forgiveness, Ghana's average debt was around 145% to GDP in the early 20s. Debt relief reduced the debt to GDP to 78% in 2005 and to 26% by 2006. And then what happened? We were excited that our debt levels were so low. And so at the time we found our way onto the international market to borrow. And then we started borrowing because obviously our debt levels were not an issue to worry about. And over time, we have built up on the debt levels. So when you look at this, you see that in over the period from 2015, our debt to GDP was 55%. It's been increasing consistently. By 2019, we were at 63%. And the onset of COVID and all the expenditure, attendant expenditure, all of them, we've seen that there's been a significant increase, with our debts by the end of last year being around almost 80%. And that puts Ghana in a debt distress level. And then we find that our levels have become quite unsustainable with all its important implications with domestic financing and external financing options. The issue that we raise sometimes is the debt is not necessarily the problem, but if you are using the funds borrowed to invest in productive sectors, then you could pay back the debt. But when you look at the data, it doesn't show that. We see that in recent times, capital expenditures have gone down in the country. So borrowing is not really financing capital expenditures. And obviously, there is a threshold. If your debt is going above 65, 70%, it's a cause to worry because it means that you don't have the capability to service your debt in that regard. What is also important that we take a look at is the distribution of the debt in terms of which people is government owing. Is it foreign or domestic? And when you look here, you see that over time, the blue bars are the domestic debt and the gray is for external. We find that in recent times, it's more, it used to be at par. We were concerned about the piling on foreign debts because it has implications on the interest, on the exchange rate, servicing the debts in foreign currency, paying back the debt in foreign currency. So it puts unnecessary pressure. And the other side of it is that if government is borrowing domestically too, it crowds out the private sector because of high interest rates. So the bottom line really is government needs to check its budget deficit so that we don't unnecessarily pile on debts. So why are interest rates high, and are they even high at all? I try to compare Ghana to other contemporary African countries and see, when you look at this, you see that when you look at Ghana, comparing Ghana to Kenya, Nigeria, and South Africa, Ghana's interest rates is way too high. We are doing more than double what is happening elsewhere. Look at the South Africans' interest rate, 7.3%. Nigeria, it's also great, but when you look at options for investment, you find that Nigeria is not doing too great compared to Ghana. So my emphasis really will be on Kenya and South Africa because we want to look at best practice. But obviously, our interest rate is way too high when you compare to other African countries. And that explains the investments that are made in the private sector. So domestic credit to private sector as a percentage of GDP, when you look at it, you see that Ghana is doing 11.5%. It is this investment that we need in productive sectors. The private sector is the engine of growth. So if this investment is not going, then it means that you find that the economy is not growing and transforming as we expect because the private sector is not getting the needed funds. When you look at the situation in South Africa, you find that they are doing way above their GDP. That is investment into the private sector, whether it is coming, so domestic credit to private sector as a percentage of GDP. And then you look at the spreads of interest rates, and you find that here too, Ghana is leading, but in the wrong direction. The spread in Ghana is 12.5 compared to other places, 2.8 in South Africa, 5 in Kenya, and then 9 in Nigeria. So high lending rates and spread reflects low investor confidence in the Ghanaian economy. Why is that? There is high information asymmetry. You are not able to, I am being mindful because someone talked about the jargons. So it's difficult to get adequate information on people in the economy. And that means that borrowers know their characteristics, but lenders do not. How do you bridge that gap? You do that by getting enough information, and that information is difficult to get. So lenders will price that risk in the interest that is charged on, what do we call it, a given financial item. And that means that because the price is high, individuals who know that they are high risks, they know they are borrowing, they don't intend to pay. They are the ones who have the courage to go for a loan at 22%. The good ones will not go for the loan. So the financial sector samples the bad, what do you call it, debtors because of the high interest rates that is charged on the market. And that is an indication that something needs to be done when it comes to the interest rates. So here, in terms of gross capital formation, we are looking at domestic investments, and the fact that the private sector is not getting enough funds is an indication of the level of investment that is occurring in Ghana. And when you look at it, Ghana is the blue bar. It is clearly underperforming all its contemporaries in Africa. So let's look at what is happening in South Nigeria, for example, is the purple with high domestic capital formation, meaning that investment is occurring in the country, and that leads to growth. We look at South Africa, which is a more stable economy, and Kenya, when it comes to interest rates and exchange rate issues, you find that because of the serene environment within, in terms of the exchange rates, the private sector tends to get a lot of funds investment. And clearly this chart is an indication of limitations in access to capital by the private sector in the domestic economy. So in terms of key trends, we see the private sector is not getting enough domestic funds. But why is that? Tier 2 and 3 pensions are great avenues for these institutions to pump liquidity into the economy, productive sectors of the economy. But remember, we know that, pensions are also quite critical, people's future funds towards retirement. So fund managers ought to be cautiously optimistic in terms of options for investment. So when you look at the MPRA report for 2020, you find that consistently, in terms of assets, private pensions assets to total pensions assets, it is growing, which is rightfully so. And then their assets are also growing. 2020, because of the pandemic, you may not necessarily find a good trend because there was a major shock over there. But when you look at the distribution of assets of private pension funds, you see that Government of Ghana Securities is consistently more than half of their investments, their assets. And closely related to the Government of Ghana Securities, you also find that local government and statutory agency securities are also next. So overall, when you tally this and that, you find that pensions funds, even in 2020, lended over 82% of their funds to governments. And it meant that 18% was left to go to the private sector. And that is an indication of the high risks and the unfavorable investment climate we find. Other options that we find private pension funds investing in are corporate bonds, bank and other market securities, mutual funds, equity securities, but these are quite small. So for example, if the equity market was developed, it's a great avenue for the private sector to source funds on the stock exchange. But when you compare, you find that the equity market is also quite shallow in Ghana, so options are not very viable. And that explains the persistent lending of private pensions funds to governments. So in 2020, you find that Government of Ghana's securities constituted 64% of total pensions investments. When you add local government securities, it is more than 2/3 of the pensions cake, if I can put it, goes to governments. The rest, corporate bonds, and also this is something that probably policymakers ought to look at. And I think it is the wisdom behind the new MPRA regulation that is asking pensions funds to diversify. But the point is, if the enabling environments are not there, these are people's future incomes and they must be managed well. So when you look at what is happening, what are the drivers of interest rates? I sought to see what theory tells us. So what is happening to interest rates? What are the drivers? Treasury bill rates is something that it's of key interest. Why? Because it is how much government is borrowing on the domestic market. And when you compare Ghana to other African countries, its contemporaries, you find that the treasury bill rates for Ghana are just too high. So for example, perhaps in the midst of all this, the risks and challenges and all that, government is offering very great rates on the market. And I mean, who wouldn't want to lend to government? Because you just have to go to sleep and just take a calendar and wait. So in that sense, you find that in Ghana, it's been coming down in recent times. That is something we need to know, because as at 2015, Treasury bill, 91-day Treasury bill rate was 25%. But lately it is around 12-13%. So that is something. But even when you compare, you find that it is just too high. We saw that South Africa is doing well in terms of credit to the private sector, but look at how much government is borrowing. So you find that government is really not competing with the private sector when it comes to borrowing on the domestic economy. So, in terms of inflation, so inflation is also a key driver of interest rates. And here I am looking at the period average for inflation, comparing Ghana and others. Find that inflation rate for economies that are inflation rate low. Ghana has done well in recent times by keeping inflation at a single digit, but 2020, as at 2020, the single digits, we are struggling to keep it. And even with the single digits, we are doing the higher band of the single digit. And that is something that managers of the economy ought to take a critical look at. So when you look at the average between 2016 to 2020, average annual inflation for Ghana is at 11% compared to almost 6% in Kenya and almost 5% in Nigeria. And critically, inflation feeds into lending rates. So that is a key determinant of interest rates. So when plot inflation against interest rates on the domestic market, you find that the red graph is for interest rates and the blue is inflation. They move in tandem to one another in recent times. So here we are moving from 2000 to 2020. In recent times, you find that there appears to be a wider spread between the two, but the shape of the graph is the same. And that means that inflation is a critical determinant. And I know that, I mean, you are all finance experts. It is in no doubt that the cost of borrowing, inflation feeds into that. In terms of depreciation of the cedi, we that changes in the rate of depreciation feeds into the interest rates or on the interest rate. And here we also plot 2001 to 2020. In recent times, you find that the trend is diverting, not necessarily moving in the same direction, but the depreciation of the currency is something that is important for us to watch. When you go into specific details of the cedi depreciation rates, we've seen that 2020 and 2022 in terms of annual depreciation of the cedi against the US dollar, the currency has performed significantly well. I think in 2020, it was the best performing currency in sub-Saharan Africa. But indeed, the threat still looms. And when you look at the cyclical spikes and pressure on the currency, particularly within the first half of the year, you find that the threats are still there. And it is important for the country to diversify away from import dependence. So despite this performance, the rate of change in average official rate is quite high when you compare to other economies. So here, I try to see what is happening in Kenya, South Africa, and Nigeria, in addition to Ghana. And you see that although in recent times we have made decent progress in terms of controlling the rate of inflation in the country. When you look at the gradient, that's the slope of the curves, you find that the slope of the annual official rates is quite steep for Ghana when you compare it to South Africa, Kenya, and our neighbor Nigeria. So indeed, exchange rate still poses a threat in terms of its impact on the interest rate. Adverse credit rating have implications on the business environment, and it also feeds into the pricing of capital. So when you look at the different rating agencies, you find that Ghana recently has not received a good rating, and that shows, it tells foreign investors prospects of investing in the country's debt. And when the option for borrowing externally is not there and government's budget is not kept in check, it means that government will be forced to come onto the domestic economy, and that has significant implications on their interest rates by crowding out the private sector. So in terms of information asymmetry, I indicated that the quality of information in the financial sector is not great. When you look at the quality of financial and investment information, there is an index that measures countries' quality of information and the coverage and the quality. The best value is 8. Ghana is at 6 in terms of the quality of financial information, and the coverage is way 1 out of 3. And this is something that we ought to look at, policy makers ought to look at in terms of regulation of the financial sector. So in essence, there are few information sharing institutions on the financial sector. And that is why somebody can borrow, default in one area and go and also get another credit, because that information sharing is poor. We need to improve on that. The business environment is also an indicator that gets priced into the cost of capital. And when you look at it, here you find that the strength of legal rights, so people's right to arbitration, timely adjudication of cases and all that, all these inform the business environment. Ghana is at 6, the best is for 12. And when you compare South Africa, indeed, when you look at to arbitration and all that, it is we are doing 50%. Extent of business disclosure, so people disclosing information, relevant information, we are at 7. The best value is for 10. Doing business ranking by the World Bank, Ghana is at 60, and here the low. And so all these are indicators of the business environment, and these get priced into the cost of capital, that is the interest rate. So see that a number of colleagues and me conducted in a number of years ago. We used quarterly income and balance sheet statement of 22 commercial banks in Ghana for the period of 2007 to 2015 in a panel model to empirically determine the spread between interest rates in Ghana, what is happening. And based on the models we use, the findings we came out is that banks' return on equity clearly feeds into the pricing, which is the spread of capital. Individual banks share to total industry assets. That is the larger the bank within the banking sector. It plays a role in the pricing. That is the spread of the interest rate. Total operating cost is also a key determinant of the price of capital. And then total provisions, largely for bad debts. Because of the high information asymmetry, it is priced into the cost of the capital, and that also feeds into the spread. Provision for taxation and fiscal policy, all these get priced into the value of the cost of capital, and that partly explains the high interest we find on the Ghanaian economy and why capital is not moving to the private sector as it is. However, in the study, we find that individual banks share in total industry deposits, monetary policy rates, and inflation targeting regimes were all observed to have moderating effects. So these were indicators: monetary policy rate, inflation targeting regime, and industries deposits try to control the interest rate a bit in terms of the spread. So overall, our conclusion was that the oligopolistic structure, meaning that in Ghana, we have a few dominant financial firms that are playing in the market. They tend not to compete as we expect, because competition is what will drive efficiency and drive down prices. But we don't seem to find that, because you have a few giant players in the market that are determining the pricing of loans. And that is probably a contributing factor to the high interest rate spread that we find. So what are the policy options to reducing interest rates in Ghana? We need to keep inflation under control because it's a critical determinant. And with the issue of inflation, the Bank of Ghana concentrates on the use of its instruments, the prime rates being the key instruments. But we also know that inflation is not wholly a monetary phenomenon in Ghana. There are real structural challenges. And those structural challenges in terms of challenges that the productive sector faces, in terms of access to relevant information, infrastructure, all the enabling environments that helps production to thrive. They are issues we need to look at in the medium to long term to try and bring down the cost of pricing of loans, which is the interest rate. But the emphasis most of the time is really on the monetary instruments. But we know that inflation is also a structural issue, particularly when it comes to food inflation in Ghana. Strict exchange rate management is critical for us to keep the rate of depreciation of the cedi under control. We know that the depreciation really is not a problem, but because of the import-dependent nature of the Ghanaian economy, depreciation has become a constant challenge for us. So there is the need for us to diversify away from import dependence, develop import substitution industries so that we do not necessarily import all the things that we import, to control the exchange rates and bring its pressure on the interest rates at bay. So government ought to curtail its borrowing as well, keep budget in check to reduce fiscal deficits, and here prudent expenditure management is critical. Expenditure rationalization, revenue mobilization efforts need to be ramped up. We find that there have been a lot of initiatives that have been undertaken, but it's not yielding results in terms of bringing in, widening the tax net. We need to invest in options to help the economy and the Ghana Revenue Authority to get the needed revenue from people that are involved in productive activities. We need to check borrowing on the domestic market. So the caveat here is government budget ought to be checked. We are struggling to generate revenue, so we need to keep the expenditure at bay as well. On the financial sector, the sector is a bit opaque. Really, you cannot seem to get a lot of information. So increase information sharing and coverage so that the risks is reduced in terms of lending, risks to lending to the private sector is reduced. Reduce banking costs. I mean, cost of banking in Ghana compared to other African countries is also quite high. And it could also be the fact that you have a few giant players who are determining the pace of the pricing of loans, so they are not too critical about the cost because they can always pass on the cost to the customer. Competition in the banking sector is important. And here, I believe that, the recent financial sector restructuring was in the hope to introduce some vibrance into the sector. We are yet to see the impact of competition in the pricing of loans, but digitization of the financial sector and the economy as a whole, we know poses significant gains for the economy in terms of helping us get around the issue of information asymmetry, being able to locate people and find them. And so when that happens, probably the default rate will go down, and then the cost of financing could also go down. Prudent monitoring and supervision of financial institutions is also essential. Better corporate governance structures, equitable enforcement of rules and regulations. All these are indicators that policymakers must take a critical look at and tackle to be able to drive down interest rates, because as it stands, the rate is too high and it's not great for the investment climate. Improvement in the business environment is also important. The time costs spent in starting a business regulation, corruption, bribery, requests by officials in accessing information and all that, stricter enforcement of laws to reduce the arbitrary nature and the unduly long processes with arbitration that is involved when an investment goes bad and you decide to use the law courts. Some people will say you might as well just forget it because it drags on for so long. These are areas that we need to take a look at, and all fees into the pricing of loans in the country. And the development of alternative markets, I'll get to this. So in concluding, I would say that the new guidelines on investment for tier 2 and 3 pension funds by the MPRA, which is mandating that fund managers diversify away from Government of Ghana securities, is important because the private sector needs the resources. But there is a bit back. This will materialize only if managers of the economy are able to address most of the inherent factors in the economy that drive interest rates. So we have to address them to drive down the interest rate. But for that, the risk is too high for pensions funds to diversify. And how can this be done? To drive down the interest rate, if it is driven down, it will improve the viability of investment options. A lot of people will dare to borrow if the price is low, to venture into productive activities that will inure to the growth of the economy, lower the risks, and develop alternative capital markets via a vibrant equity market to get alternative asset class. Because as it stands, the alternatives are not too great. When you look at, for example, capitalization of the Ghana Stock Exchange, the index, the rate is so low when you compare it to other African contemporaries. So all these are issues that need to be addressed for interest rates to come down. I thank you very much for your attention.
Thank you very much, Doc. Please let's put our hand one more time. And there are a lot of questions waiting for you, Doc, but I know that you have a good on your feet, and so minutes for you to catch your breath, and then we can take the questions thereafter. So ladies and gentlemen, like I indicated, the Q&A session would be in 2 forms. We'll have another presentation done once we have taken the keynote presentation. We'll have the next presentation also done. I noticed that there are still questions coming in even for our first presenter. And so we will try and make space for Carl to respond to some of those questions. And then we will go to our next presentation. We will take some questions that would also be coming. And then we would also create some space for those who are directing questions at so that she can also respond to it before we go to our panel discussion. And so our earlier presenter, Carl, a few things were also our theme. So we would have, I'll read out some of the questions. We will have Carl respond to them. The first question to Carl after our presentation is from Francisca. It says, are Eurobonds a good recommendation currently, given the high debt levels and potential for defaults being experienced by a lot of sovereign states lately? Adam is also asking, and Carl will take that one as well. It says that the funds are heavily invested in government securities. Government clearly has liquidity challenges. News is maturing debts are being rolled over. How is this expected to affect pension funds? So 2 questions for Carl. Number 1, what is your opinion on the Eurobonds, recommendations on Eurobonds? And given that we are heavily on the government securities, what's your recommendation for pension funds?
Thank you, Jeff. Thank you, Francesca, for the question. So I'm trying to answer this question while trying to be a patriot as well on the Eurobond issue. In terms, so for every investment has a risk and return element. So let me start with the easier option or the easier response first. From a return perspective, and this is from a Ghana perspective. From a return point of view, yes, Eurobonds currently are trading at very healthy levels, and by healthy levels, I mean you can earn, close to 13 to 12%, depending on the tenor, on a US dollar, on a Eurobond. And so, yes, from that point of view, it's a good investment. But every investment comes with risk. Now, Eurobonds are issued by the government, and so you're taking a risk on the government. And so when I think about a credit risk, you're thinking about the willingness of the issuer to pay as well as the ability to pay. And from a willingness perspective, I think governments usually have all the intention to honor their debt obligations. And so from that point of view, there's probably less risk there from a Ghana perspective. Now, in terms of ability, and I see your question was tailored towards the ability of governments to pay. I think there's been a lot of noise as well regarding the macro fundamentals, especially from the international capital market perspective. Even though the fundamentals look somewhat shaky, but I say this because amongst African nations, Ghana has probably one of the most diversified natural resource base, and so our ability to continually earn foreign currency or earn exports are in a better position than others. If you look at our fiscal position, even a 10% cut in expenditure changes the narrative dramatically. And so Ghana has an expenditure problem as well, which internally, if it seeks to resolve, can easily do. So from that point of view, I believe that from an ability perspective as well, Ghana can intend honor its obligations. So from a risk return perspective, I'll say yes, Eurobonds do make a good investment.
I think the other question had to do with our overexposure in government securities and the risk that presents to us.
In terms of, thank you, Adam, for the question. So I think the market is such that there are dearth of opportunities when it comes to investment opportunities. And so when you look at the asset allocation of most pension funds, majority of it goes to, hopefully with the opening up of the new guidelines and with fund managers supplying new investment opportunities, there will be a multi-universe of potential investment opportunities to invest in. Now, with government rolling over its maturities and its implication on pension funds, obviously, if rates do intend to go up, then you are able to reinvest your cash at higher yields. But if you are market to market, then it then presupposes that, the value of those assets also may be declining. But in our space, we usually don't mark to market. And so with yields going up, you expect much more deployment of cash into government securities for the simple fact that people perceive that they are able to earn higher returns. But the narrative changes if you slap in inflation and what's happening in inflation, bearing in mind that it's real returns that you be focused on. Like I mentioned earlier on the 91-day, 182-day bill, your real returns are being squeezed out due to inflation. And so naturally, people will either be forced on the longer side of the yield curve or look for alternative investment opportunities, such as equities and so on and so forth, that can a return above inflation. Thank you, Adam.
Thank you very much. Please let's put our hands together for Carl Okran. And we certainly see all your questions coming in. Yes, I noticed that the questions are coming in and commendations are also coming in. So, Doctor, thank you very much for your presentation. People are really excited about it as well. I think Owusu said you are the best economics lecturer in the last decade. So certainly people have enjoyed your presentation. Ladies and gentlemen, before Doc comes in to respond to her questions, we will take another presentation. This presentation will be done on the strategic asset allocation within the new pension guideline. It is presented by our colleague here at Access, who is the Chief Investment Officer. He is also currently the President of the CFA Society Ghana. Please help me welcome on the presentation strategic assets allocation within the new pension guideline, Nana Riafi Buama. Please let's put our hands together for him.
I think it's still morning. Good morning. And thank you very much, Access and the CFA Institute, for this opportunity. So my presentation today is about how pension schemes optimize value for members through strategic asset allocation. I'll be taking you, back to your finance and investment classroom. I've heard the comment about watering down the jargons. I'll try as much as possible to do that. In case the jargons are still heavy, forgive me. I still have it in mind, only that I don't have much options here. The purpose of the discussion is also to provoke actions amongst us trustees into allocating pension resources to growth assets like equities, both private and public. And I would also prove that the returns in such allocation is worth the allocation. I will begin my presentation by walking you through what multi-asset investing is. I will touch briefly on strategic asset allocation and how pension schemes can allocate funds amongst the permissible asset class allowed by MPRA. I will dwell briefly on alternative investing opportunities in the country and finish up my presentation with ethics. Now to what multi-asset investing is. I have multi-asset investing defined as a strategy that combines different types of assets. For instance, equities, bonds, real estate, private equity, private credit, cash, to create a more nimble and broadly diversifiable portfolio. And why do we do multi-asset investing? We do expect multiple outcomes, right? Investing in multi-asset portfolio. In most cases, a multi-asset mandate would have an objective. How do we achieve that growth objective? It is by investing in growth assets like equities. In our case, over here, in Ghana. A multi-asset would also have an income objective, where, objective is basically, to collect, cash flow. In this instance, plays the role. In our market here, where averagely over the last 5 years, fixed income returns or government of Ghana returns have averaged 18%. This is pretty much a no-brainer. And that is why you would see shortly all of us allocate so much of our assets to fixed income. There's also absolute return. When doing multi-asset investing, strategy, an asset that has a low correlation with the traditional class, and that is where absolute return is like Europe, where there are certain whose mandate is to outperform the equities or fixed income does poorly. Absolute return a big role, and it's a cycle approach. You invest to mimic a certain life cycle. You invest to meet expectations of the various members within the investment program. And I guess the MPRA new guideline addresses that. Now, having laid the foundation for what multi-asset investing is, let's take a look at how Ghana's private pension allocation compares with other markets. So you take a country, Zambia, of their total pension asset to equities, compared to Ghana, that is doing 3% in equities, and then 95% allocation to fixed income. And I guess Uganda cannot be better than us, right? Zambia, that was last year, cannot be better than that. Of course, this statistic for Ghana excludes, what SNIT, is doing, but it is probably a reflection of what happens. Nigeria cannot, be better than us. They are doing about 11% in equities, whilst we are doing 9%. And I would want to yet a little bit and apportion blame. So, since the coming to fore, first of all, the stock exchange have not attracted many interesting listings. I think the interesting listing over the last decade will be MTN. Successive government over the last 10 years have failed in their commitment to develop our market by listing some of the best public sector companies onto the Ghana Stock Exchange. All over the world, the listing of such public companies has been the tool government employs, especially in frontier and emerging markets, in developing the market. What is our experience? Secondly, I would say our best-in-class investment banks have been busy making a killing, selling government papers, and therefore have no zeal whatsoever pushing for private companies to list. Care about the share price performance of their firms, and they leave behind a trail of so many disappointed investors. I wouldn't want to list names, but I guess the apathy towards equity lately is because most of the pension trustees got bent in companies like PBC, CPC, Clystone, Transol, and all those that companies currently trading on our market. And I guess, this year, we all have to change and drive up our market, which in my view is currently trading on a relative valuation basis at an all-time low. I've heard some analysts painting a not so good picture of our market on the basis that foreign investors will sell out or will not come in due to our current fiscal situation. And my question is, how do we compare a 200 million, 300 million pullback in stocks compared to over 3 billion available liquidity pension funds can inject onto our market? Don't worry, cheap currently without companies releasing their full year numbers. Immediately full year numbers come out, most of our analysts will be waiting for Q1 before we make a move. If Q1 disappoints, even despite the current low valuation, investors, will freak out, probably not invest because performance didn't turn out well. I guess the responsibility to drive in our market falls on us. Now I will touch on strategic asset allocation after having thrown some jabs on all of us gathered over here. Strategic asset allocation plays a number of roles in multi-asset portfolio. With strategic asset allocation, one is able to specify their desired exposure, right, to undiversifiable risk, and therefore determine what kind of assets they will put in their investment program. The importance of strategic asset allocation is underscored by the fact that 90% to 95% of investment returns are attributable to strategic asset allocation. The remaining 5% is from our fund managers' activities, timing and security selection, which contribute, like I said, barely 10% to overall return. And I'll prove why this is so shortly. But before then, let me walk you through how we determine strategic asset allocation for an investment program. So the yellow shaded boxes talks about the investor's specific circumstances. So in our case, running defined pension schemes, our unique circumstances would be one, the size of the assets we are managing, the liquidity need of that particular investment program. If it is a tier 2, we know withdrawals are quite a distance away. Tier 3, depending on the vesting rule, liquidity would be often. We can also determine the risk attitude of the scheme by aggregating the average age of the members within that particular scheme to determine the likely investment horizon. For an individual, your unique circumstances, again, will be driven by your net worth, your risk attitude, your risk appetite, how much time you have to invest. Now, green shade box talks about capital market condition and how they affect expected return, risk, and correlations amongst asset class. Now we combine the yellow shaded boxes and green shaded boxes and run them an optimizer. I will show you that shortly, and then determine the appropriate asset mix and investment program is supposed to have. Before then, let me walk you through how we do the capital market condition analysis. And I guess, the exercise Carl took us through is born that. So for, Access, every year we test the market on what to expect going forward regarding our capital market. And based, on that, we take some tactical asset allocation decision. So for instance, how do we determine, or how does capital market condition influence our asset allocation? Over here, I show an example of what we can do when we expect inflation to be above or below expectation. So for instance, if we expect inflation to be above expectation, we would be expecting cash assets to probably outperform because of the low maturity. But then for bonds with higher maturity or higher duration, there is an inverse relationship between higher inflation expectation and the bond's value flowing through higher interest rates. And we don't do that in our market. But I guess if we're marking to market our bond position, then you will know that higher interest rate is not always a friend of yours, especially if you are re-rating, the value of your securities. Now, what about inflation impact on equity? Equity tends to generally do poorly when inflation goes high. However, within the equity basket, there may be some companies that are able to pass on higher inflation onto customers, and those, becomes a good buy. And in our market, I guess a lot of those companies abound. Real estate has a positive correlation with higher inflation expectation. Now, having touched on this, I would walk you through strategic asset allocation using this as a basis for determining optimal asset allocation. This is the MPRA's guideline. The second column has the old investment limit, and then the third is the current limit. So for Government of Ghana securities, we can do up to 75. For local government, we can do up to 25. For corporate debt, up to 35 with an issuer limit of 5%. Ordinary shares, 20% with an issuer limit of 5%. Bank securities, collective investment schemes, and alternatives. The interesting thing about this guideline is that implicitly the regulator has set a floor on how much we can do in risky assets. This is a multi-asset investment guideline. How does this compare to what currently pertains, where in about 3% to risky assets and doing about 95%, 96% in fixed income? And where it is fixed income, it is not fixed return. So your return is not determined, it's not known until the end of the investment horizon. So I demonstrate how we can determine optimal asset allocation using the mean variance optimization approach. So the table over here shows 4 permissible asset classes, right, within the new pension guideline. So Ghana bond, that is the sovereign Ghana bond. And I use the S&P Ghana Sovereign Bond Index as a benchmark. Equities, obviously, our GSC, and we are allowed to do 5% outside of this country. And I use the MSCI World Index as a proxy. And commodities, the guideline does not explicitly mention commodities, but on our market, on the stock exchange, there's an instrument called the GLD. That's the Absa New Gold ETF. That is a gold ETF, which means it mimics the characteristics of gold. And I feel, we can use, that to diversify from the traditional, asset classes we know. I show over here the 10-year historical returns for this asset class. So for bonds, over the last, 10 years, the returns has been 18.19%. Our equities 10-year return has been 15%, right? I added a 2% average dividend yield, and that brings the total return to about 17.16%. Interestingly, the world, stock market has done about 43%, and this translates to about 27% or so in dollar return. And since, we are determining our asset allocation in CDs, adding the depreciation over this 10 years takes the total historical return to 43%. Gold, Absa, ETF, which is often overlooked, right, has done 21%, higher than our bond market and higher than the Ghana Stock Exchange. And this is obviously the standard deviation, which measures, the degree of risk inherent in this asset class. Now the below, shows the correlation, right, amongst, this asset class. And investment, they say diversification is the only free lunch. So it is always better to diversify across multiple asset class. And in diversifying, you want to diversify across assets that are negatively, has a low correlation. And this is what we see over here. So equities, obviously, is negatively related, to bonds. We have the other asset class lowly related, to the other asset class. So you take Ghana bond, for instance, and the correlation between Ghana bond and the MSCI index is 0.14%. Between Ghana bond and the GLD is about 0.1%. Between equities and the GLD is about 0.04%. So even though the GLD is listed on our market, we see or we observe a very low correlation compared to the market. And that, like I said, is a source for diversification. Now, having determined this historical returns and standard deviation, we run the output through an optimizer, and Excel has that function to determine what the optimal asset allocation is. Our mean variant portfolio, which is the portfolio that generates the highest return per a measure of risk, would have about 56% in government of Ghana bonds, would have about 30% in external investment, i.e. the MSCI index, and about 14% in the new gold ETF. This would generate an expected return over the last 10 years of 26%, standard deviation of 8%. Using the risk-free rate as our benchmark, this portfolio would generate a Sharpe ratio. And a Sharpe ratio is basically returns in excess of our risk-free rate divided by 5%. Obviously, per guideline, we cannot invest 30% outside. We can't do 14% in a single asset. There are checks and balances. If we are to allocate among this asset class to remain compliant, for instance, with the MPRA guideline, this is how our optimal portfolio would look like. 75% in government bond, 10% in equities, 5% in external investment, 10% in the GLD. And this asset combination would generate a return of 19.6%, standard deviation of 6.14%, generating a Sharpe ratio of 1.13%. And I guess 19.6% is not a bad outcome, even allocating to risk asset. And mind you, the MPRA compliant portfolio does not include certain high yielding fixed income assets like corporate bonds, the local government and statutory agency securities that offers opportunities for higher yield pickups. By reducing this 75% by 20% and allocating to the local government and statutory agency securities and corporate bond, we could easily have added about 2% to this return. And probably, lower standard deviation because those assets offer opportunities for diversification and therefore a higher Sharpe ratio. Now, to prove the academics right, that asset allocation contributes significantly to returns in any investment program, I show you what the MPRA compliant portfolio from the optimization we just ran to what actual returns for most of the schemes we administer. So for all of Access's administered scheme, return since inception is about 19.06%. And mind you, since inception, it's not even up to 10 years record we use for this. So after all the hard works, our fund managers put into managing our pension assets, they are doing lower than what the optimal portfolio generated. Of course, this is net of fee and this is gross of fee. But like I said, there were still more opportunities for yield pickups over here. which is, to say allocating monies into risky asset is not bad after all. I did, this, just to prove, a point. And the point I wanted to prove is that, in my view, investment management is probably more of a science than an art. The conclusion from what we just, saw does not justify the lack of allocation to other assets besides fixed income, irrespective of our structural problem, irrespective of high interest rates. I do believe that the opportunities to add in value to pension schemes through allocations, to equity. And the equity I used is probably, for the whole index. Within the index, there are some winners within the component, the composite index we could allocate to generate higher returns for our schemes. Now, I would touch briefly on other opportunities, right, to add values to our scheme through the alternative investment space. And I would like to introduce infrastructure investment with this picture. I would read the first few paragraphs to underscore the role pension fund can play in funding critical national infrastructure. So let me read. In April 2015, Greater Manchester Pension Scheme, which is a scheme in the UK, and the London Pension Fund Authority formed a joint venture to invest directly in infrastructure assets with a focus on the UK. The joint venture is structured as a limited liability partnership and has been named JLIL Infrastructure. One of the earliest transactions was the purchase of SSE of a 21% stake in Clyde Wind Farm for 150 million. This is the UK pension scheme putting their hands where their mouth is. Fortunately for us, the new pension guidelines provides opportunity to invest such assets, of course, under certain conditions. So one, all project finance should have a government or government agency participation. It should be underwritten or should have bank involvement or multilateral or bilateral development financial institution as an arranger. And then also the MPRA needs to approve. In assessing infrastructure investment, we can talk about the four main plays. So the core infrastructure, the core plus, the value add, and the opportunistic infrastructure. And under all these four plays are the type of assets that are available. So for the core infrastructure, where returns are stable, where the maturities are longer, we have opportunities within the gas, the electricity, the waste and water. And I guess, these are problems that confront, Africa, that confront, Ghana. And the question is, are we, going to combine force? Are we going to, brace up and exploit some of these opportunities? Over here, I would want to say our fund managers, we are, open. We are open in as long as it would add, valuable return to our schemes. We are open to support. In assessing these opportunities, our fund managers should keep their ears on the ground, right? A lot of these opportunities come through the banks. And given, what we have now as a new investment guideline, we should form very close partnership and association with the banks to siphon out some of these opportunities and then assess, what impact it could make on our schemes. Now I would move, straight to opportunities within private equity and private debt. And over here, I won't say much, only to show you thriving companies who have made it with PE investments. MTN, from their transition from Ariba and all those companies, had significant private equity play. Vortec, the same. Akramo, the same. Fidelity. Gensa, unfortunately, all that were owned at the point or are owned by foreign PE fund. So they come in here, assess the opportunities, invest, multiply their money, and take everything out. And then we complain about currency depreciation, and we complain about no opportunities in the market. Thankfully, this is a hospital in Tema, Sinel. And Sinel, I don't have their permission, but fortunately, the information are out there in the public. This was done, by Oasis. I live in Tema. Anytime I drive around Tema, I feel so proud that my 100 cedis a month in pension contribution is building the real asset. This is Agri-Mart, and this is an investment in Jaro did years ago. We went there, we're so proud what they've done. So the key point is there are opportunities within this space. And I know most of these private equity firms have been begging and knocking on our doors for years, for money. And we haven't responded as we should. I'm happy to say we've supported, in Jaro, or committed about 20 million to the fund they are raising. We've committed about $3 million to the Oasis Fund, and we like the result. We like the result. I'm not marketing for them, but I'm saying by all means, assess the opportunities. And then if you like it, don't hold back, invest, because together they help grow our economy. And the awesome thing about the investment guideline is that our regulators have put in enough checks and balances so as to avoid catastrophe when an investment goes bad. So there is, for instance, an issuer limit. So for this fund, there's no way we could do more than 5% of our total assets. What we have internally at Access is a limit of 2.5. So should we even put 2.5 in private equity and we lose everything? Our funds are protected. I'm not saying, we'll do that, but there's enough check and balances to ensure we are able to allocate monies into the real sector for value maximization for our funds, whilst at the same time checking downside risk. And I guess, most of us, invested in PBC, right? And PBC, went bad. Did we die? In spite, of that, we're able to churn out, good returns of an average of 19% for our schemes. We should aim at 30% return, 25% return. It's possible through some of this allocation. The amazing thing is, pension funds in the US are generating 13% in returns in an environment where interest rate is probably below 2%. How are they doing that? Through some of these opportunities. Now, I would want to round up my presentation, but then if you ever forget everything I've said, please do not forget this slide. This slide, addresses the fiduciary responsibilities of trustee. Of course, curled, from the CFA Institute curriculum. I'll quickly read through them and make comment when necessary. So as trustees, we are supposed to, in good faith, best interest of the participant and beneficiaries. Unfortunately, most of us on trustee boards act in our own interest. So there were people who got stung from investing in equities. And because of that, they don't want to hear equities when a lot of opportunities abound in equities. Don't forget, add in the interest of your plan participant. Most of them, probably young, who can ride out utilities in risky investments. We are supposed to act with prudence and reasonable care, act with skills, competence, and diligence. And I guess that is why we are having, this seminar, just to impart some skills to our cherished trustees. We are supposed to maintain independence and objectivity by, among other actions, avoiding conflict of interest, refraining from self-dealing, and refusing any gift that could reasonably be expected to affect your loyalty. No commissions. You don't place money in the bank and then go for kickbacks. It is absolutely wrong. And whilst we are pushing for alternative investment, you don't bring some investment owned by your family, for Nana to invest in. You have to disclose. We will assess the opportunity. If the opportunity makes sense, we would invest. Abide by all applicable laws, rules, and regulation, and in this case, the MPRA guideline. Do not deviate from it, otherwise you will be punished. Deal fairly, objectively, impartially with all participants and beneficiaries. take actions that are consistent with the established mission of the plan and the policies that supports the mission. So if you are a fund manager here who is managing a mandate that has 10%, 5% allocation to equities, and you are doing 1%, you are flouting this law. Review on a regular basis the efficiency and effectiveness of the plan successes in meeting its goals. And we all do our regular interaction. Maintain confidentiality of plan participants and beneficiary information. That is why we don't share names of the people in our schemes. And then lastly, communicate with participants, beneficiaries, and supervisory authorities in a timely, accurate, and transparent manner. Every scheme, in my view, should at the end of every year send their annual report to their plan beneficiaries. It is very, very important our members are up to date with what is happening. And to just close it off, these are my final thoughts. Strategic asset allocation contribute largely to the performance of every investment program. Investing about 10% of your assets will not hurt you, will not kill you, but then exposing your assets to equities presents so much upside when equities do well. Regulators must legislate marking to market of fixed income with more than 1 year to maturity. And this is so dear to my heart because oftentimes we compare apples with oranges. Equities are marked to market, every day. Ask me what the value in my view of MTN is, and it will not be the 1.05 it's trading at, right? There's regular mark to market of equity securities. However, when it comes to fixed income, we don't want to mark to market, and that creates that asymmetry. That pushes people away from equities. If we're marking to market fixed income securities, would all ascertain in such investments. And I guess the Ghana Stock Exchange should also do some house cleaning, especially around float of desirable companies. Sometimes it's so difficult to get your choice companies when you want to invest on a market. And to say, private equity has arrived in Ghana and schemes should actively engage fund managers on these opportunities is an understatement. We should explore some of these opportunities. And then strong ethics is the bedrock of our industries, and we should never, ever compromise ethics. We don't want to lose the confidence of our members, as has happened in the wider asset management industry. And we should at all costs uphold the highest level of integrity in our day-to-day dealings. It's the month of February, month of love, and also my birthday. And doing this in February. I end my presentation by sharing some gifts. These books, have helped me, greatly in my work. And I guess, for all of us here who are probably fiduciary, sitting on trustee boards, or are scheme participants who are members of our schemes, you should avail yourself to some of these, opportunities, because by expanding, your wisdom and your knowledge, you are able to give, proper feedback, to us to ensure we manage your monies well. Thank you very much for listening.
Thank you very much. Please let's put our hands together a little better for Nana Riafi-Boamah. Thank you so much, Nana. Nana is the Chief Investment Officer here at Access Pension Trust, and also the president of the CFA Society, Ghana. Ladies and gentlemen, again, I just want to recognize the fact that we are receiving all your questions, and at the right time, we would respond to them. The next activity we'll be doing is a panel discussion. What we'll be doing is that for those of you who have sent questions to Trumesi and Nana Riafi, we would direct the questions to them during the panel discussion. And so we'll move straight into our panel conversation. I'll call the panelists, two of whom have been here already. So I'll humbly ask Nana Riafi-Boamah to please take a seat. Please let's put our hands together for Nana Riafi-Boamah. Also, Dr. Priscilla Trumesi Bafo, please let's put our hands together, Department of Economics, University of Ghana. I'd like to also invite Ni Ampasoa, Associate Director, Data Bank Asset Management Services. Please let's invite him. Madame Musope Arubayi, economics at IC Group. Please let's put our hands together for her as well, even as she takes her seat. And last but not the least, we would like to invite Eric Apia. Please let's put our hands together for Eric Apia, who is the managing partner for Black Star Advisors. Our panel will be moderated by the managing director of Stanbic Investment Management Services, and he is in the person of Mr. Kwabna Boama. Please, a round of applause for Kwabna Boama. And so at this point, I'll hand over the microphone to Kwabna Boama, and the conversation will cut across what we have discussed over here and any other related issue. Thank you very much, Kwabna.
I believe it's been a happy and an inspiring conversation so far from this. And just to remind us that we're looking at improving member outcomes through scheme design. I saw this writing on the cover of a book on Amazon that said that retirement is not the end of the road, but the beginning of the open highway. I believe what we are doing here is preparing our scheme beneficiaries to prepare to navigate the highway tomorrow. Some are happening as we speak. Hopefully they are not changing their date of birth. Others are also going to happen in 5 years or 10 years. But these are healthy conversations, and Access Pensions Trust, well done for making this happen so that we can ensure that tomorrow all our retirees can actually navigate the retirement journey. I will first start off, and I believe that your credentials and names are on the brochure, so we don't need to do much of introductions, but we'll do a bit of an order from the economy. So I'll start with our economists who are on the panel. That's Moshope and then Dr. Chumesi Bafo. What is your general assessment when it comes to what we are seeing now in Moshope? From where you sit, looking at Africa, what is your general assessment of how Ghana is doing economically? Hello?
Thank you very much for your question. From where I sit, yes, the fiscal narrative isn't so appealing, which we all agree with. However, we should also understand that it's a regional-wide phenomenon. So it's not peculiar to Ghana. Nigeria has its own fiscal peculiarities. Even South Africa, with all the good numbers that Dr. Priscilla projected for South Africa, they still also have their fiscal concerns. But one thing is clear: Ghana has growth potential, which is a fundamental for driving revenue growth. If they're able to optimize that growth, you're able to generate more taxes, unlike in Nigeria, for instance, where we're stagnant in terms of growth in the economy, and there are lots more leakages in terms of revenue generation. I think tax to GDP for Ghana is about 13%, and Nigeria does about half of that, even though the size of the economy is quite large. So looking at it like from a relative perspective, Ghana has better chances to turn around the narrative, and the fiscal concerns that we've all been talking about since last year. It's not peculiar to Ghana. It's just because we have a situation whereby there's a benchmark, which is about 65 to 70%, like Dr. Priscilla highlighted, and Ghana is already off that benchmark. That's what is generating a lot of concern. But like Carl also highlighted in his response to this question, if the government is able to discipline itself, implement a cut in its expenditure, then we're going to see a lot of those concerns ease.
Great. Dr. Tracy, let me find out from you. I mean, recently we've seen the downgrading by Fitch and then S&P. Are these ratings overrated? Should we be concerned as a people?
Indeed, it's a tough one. It's a tough one because countries subscribe to these rating agencies because it is based on the objective assessments that you get access to funds on the international markets. But then again, on the back of all that is happening, you find that sometimes the ratings come and is more like the final nail on the coffin. There's a lot of potential, like Ms. Ope indicated, in the Ghanaian economy. And as I did the presentation, I indicated, but for COVID, we probably would not have been having the conversation we have because the Ghanaian economy consistently does well. The challenge we have is for the transformation of the economy to grow in the right sectors and the right areas to generate the needed jobs that young people require in the economy. But for prospects, it is there. The challenge also on the fiscal side is generating enough revenue. So as indicated, I mean, 2020, we did like 14%. We are hovering around standards. Ideally, if we could get to 22% thereabout, then you see that with whatever growth we are able to generate, we'll be getting enough resources for investment, enough resources, and we will not be borrowing for goods and services and consumption, because as a developing country, we need the capital investment, and that is where the challenge is, and that is where we get worried when the growth to GDP gets that high. Like I indicated, the rate itself is not really the issue, but when you go into the debt service to revenue generation, then you find that if all the revenue you are generating is servicing the debt, then indeed what is left for the daily running of the economy and all that. So it's more like the devil is in the detail. The rating agency has put a lot of bad press on the economy at the time it came. But I mean, there's been a rebuttal and all that. But indeed, when you do detailed analysis, the prospects are great, I must say. And yeah.
So my thoughts, Ghana recorded like 2 downgrades, if I'm correct. One from Fitch and the recent from Moody's. In my opinion, with the recent fiscal concerns, probably the Fitch downgrade was the most logical, because at the time, Ghana had like a seemingly more premium rating of B. Most African countries sit on the B negative grade, irrespective of what happened with COVID. Most African countries were downgraded to the B negative on the Fitch grading system, but Ghana was sitting on a B. So with the recent concerns over ambitious revenue target, it only made sense for a B negative downgrade. But the Moody's downgrade to a C, I feel it's an unfair judgment, because a C-triple-A1 country, like a similar C-triple-A1 country in Africa is Tunisia, and Ghana's fiscal profile is far ahead of what Tunisia is currently experiencing. They're overly reliant on external and finance. I mean, the external debt to GDP is about 94%. That was as at 2020. So clearly 2021 probably be a much bigger mess. Ghana is much less. I think about 30, 38 or thereabout. So there's still more potential. I just felt the CAAA1 downgrade from Moody's was premature, or it was even unnecessary. It would have been more prudent because they also have the power to trigger like a reaction across rating agencies, which would have implications for Ghana's borrowing costs at this time. So if Tunisia and Ghana's fiscal profile are not the same, then they shouldn't be having the same rating on the grading system. So maybe unfair judgment from the part of Moody's, but I think the downgrade from Fitch remains a visible one.
Great. I think there's a positive light ahead. But given this context of Ghana's potential, however, in the midst of our deficit, concerns about our debt sustainability, and then looking at Dr. Chumesi Bafo's presentation, looking at spreads or real returns in Africa, should we expect interest rates in Ghana to go up again, given where we currently are? We're about 20% on the long end of the market. Inflation is comparable within the comparable countries that you talked about, Nigeria, Kenya. Meanwhile, their interest rates are much lower than us. In the midst of these concerns, should investors still be expecting compensation for additional risk, if I may say, on Government of Ghana interest rates? Dr. Chumesi. Beneficiaries are watching interest rate movements.
Exactly. So indeed, when you look at the interest rates movements, I would say that on the part of the commercial banks, the lending rates, the spread is just too high, right? So for Government of Ghana instruments, T-bills, and we've seen that consistently it has come down. And at the moment, I think we are doing within the band of 10 to 12%, right? But when you go onto the commercial rates, you find that the rates within the private sector, the lending rate is just too high. The spread, why is it that consistently the prime rate is quite around 14.5%? The lending rate is around 20%. And over time, you see that there is that, I think that was the wisdom behind the Ghana reference rate to try to, so what is it? Like we have comparable inflation rates with other countries. So what is it with Ghana that within the banking sector that is so hard to grapple with, for which reason rates do not come down? Is it more of a policy issue? There is a school of thought that is asking, should the central bank mandate banks to fix interest rate within a certain band? Is that a viable policy option? It goes contrary to market forces and all that. But indeed, it is something that is of a worry. But for me, on the part of investors, inching for increase in the rates that government is paying is counterproductive, really, because you get it and then it feeds back into another way. If government gives you 50% and the inflation rate is like, at the end of the day, you have not gained any real returns. So that is, but the issue of the interest rates, I think it is a hard discussion that policymakers ought to have. The Bank of Ghana needs to get to the bottom of this, because even at the height of high competition in the Ghanaian financial sector, a number of years, about a decade ago or so, interest rates were still quite high on the Ghanaian market compared to other African contemporaries.
Moshope, do you think that policy driven, or we should still allow the market to find itself when it comes to interest rates?
I mean, I'll use Nigeria as an example, and going by the slides that Dr. Priscilla presented, credit to the private sector in Nigeria as a percentage of GDP seems to be a bit higher than what we have in Ghana. And what I'll say is, in as much as we in Nigeria have bashed the central bank governor for intervening in the structure of how interest rates are determined, I mean, lending rates, so to say, because there's a system whereby there's a special window for critical sectors of the economy to assess finance at a much lower rate, I think about 9%. So critical sectors include agriculture, manufacturers, and some other sectors that are of interest. Most recently, health. Some other sectors that are of interest to the central bank. So they had to do that intervention, even though it's not a market welcome move. But then we've seen the impact of that on credit to the private sector. We've seen credit to private sector grow as a result of that intervention. So sometimes we probably need to look beyond normal conventional monetary policy tools to address some of these structural changes. I mean, quantitative easing wasn't a traditional tool at some point, but when interest rates were low and the central banks in the West had to stimulate demand, they came up with that with QE as a tool. So African economies are structured differently, and we clearly have structural challenges that we're still yet to address. So if we can come up with some of these unconventional ways of addressing some of these challenges, so that we won't be burdening our economies with high interest rates, because whether we like it or not, commercial banks have to be profitable in when they're lending. They would always add the risk premium inherent in the economy to whatever facility it is they're giving out, and these high interest rates would persist if we don't have a mechanism to address it. I mean, like maybe an unconventional mechanism to address it from the policy perspective.
Now, our fund managers, I know one of the investment objectives or the pensions objectives in the new guidelines is for pension assets to impact the economy. Interest rates are very attractive, and from the speakers that have come, it's a difficult conversation to bring it down. Now, how do we allow pension schemes to impact the real sector in the midst of high attractive interest rates? Maybe I'll start with you, Eric.
Sure, thanks. A difficult question, because the truth is that the pension guidelines have been set for us. So until those change, it's unlikely that we'll be able to do much more than what has been given to us. So if you look at the relatively high government allocation that we have, couple that with, I think Nanaboma spoke about, he spoke about the allocations, and there just aren't enough private companies that are coming to markets, even on the debt or the equity side, that want to actually raise money, and that's given the current environment in which they are. For us to be able to make sure that we have a bigger impact, we have to encourage more companies to come to market, but we don't want any company. You need good companies to come to market. Now, the market has a good way of looking at risk, and so if you're a good company and you come to market, you'll get credit at the right price, or you'll get equity at the right sort of price. So it's the fund managers have been given a remit which gives us a certain band, but we also need to encourage companies to be able to come onto the markets and to the capital markets to absorb that capital.
Thank you. I mean, Nana, from the pensions trustee side, and I guess you're speaking on behalf of scheme beneficiaries, was quite bullish on alternatives. And he believed that alternatives will have a considerable impact on the returns or the outcomes of pension schemes. In the new guidelines too, the authority says that we should look at safety of investments. And we know in finance, the higher the risk, the higher the returns. However, our underlying beneficiaries do not believe in risk. How do we marry these two extremes? And from where you sit as a portfolio manager, how do you manage these two extremes?
It's a very difficult question. But I guess I'd like to take a step back and from an investor's perspective, try and answer that question. Yes, if we could get an investment option that didn't have as much of a high risk, of course, we'll go for that if it's delivering a good return. So, I mean, for proponents of those who would want us to invest more, allocate more capital to alternatives, what are the other options providing? And the legislation, the regulations have a high allocation to GOGs. We've had 10 years of history in the pension industry, and yet we are barely seeing investments in traditional public equities experiencing a real dent. Eric spoke of the death of options in terms of listed and even unlisted securities to invest in. So, I mean, when one talks about alternative investments and trying to direct capital there, it's something that I struggle to appreciate, because really there's a dearth of options, and among them, I mean, Eric referred to it as well, you need good companies to want to really participate in. Away from that, from some of the experiences we've had, those that are even available, it takes too much time for them to, technically speaking, come to market. I mean, I think Nana's presentation touched on Injaro. I think it's been, 4 years or so since that conversation started. And there are others like that that are taking long for various reasons. Some regulation, some our own fund managers not understanding the asset class enough, due diligence wise and stuff. It's really difficult. Would we want to participate in it? Of course we will. But I think the economics must make sense. It should be an investment that is worth the risk to take. If in the presence of other better performing low risk assets, you're presenting that option to me, it's going to be a very difficult ask, unless you have staying power like Dada, and Axis Pensions.
And sorry, just to add to what Mia was saying, and it's really important, so the question is, why don't we have many good companies? The truth is that the banking sector serves those very good companies very well. The ones that don't seem to have access to the credits and the financial side are the ones who then have to come our way sometimes. And so we spend a lot of time actually telling people that your businesses are not ready for the kind of market that we are. If you have an issue with an entity, you can have a conversation with your bank. They can easily restructure the loan, etc. It's very difficult to do that when you come to a public market and issue a bond, or you have equities and try and negotiate that with shareholders or debt holders in the open, because that has all sorts of consequences, right? So if you issue the bond and you're trying to restructure it publicly, everybody knows that you're toxic. So then it becomes even harder. So you find that companies who would even want to come have that issue of, well, how do we renegotiate a debt that we've issued if we're having problems? So there are several things around, insolvency laws, etc., bankruptcy that we have to look at closely, so that if a company defaults, there's a well-organized process, and I think there's new legislation to that. But we need to be sensitized more to that and how the courts react to priority of priority of assets in the form of insolvency, etc. I think once we build those things and there's a clear sort of pathway to what happens when a company, misses a payment or defaults, I think that would make it easier for people to understand. And when people come to market, they may not be so scared to invest in them overall. So
if the natural default is to do govies, and like you're saying, we are not finding the alternatives on the market. Nana, let me ask you, do you think it's about time that we begin to take external investments seriously for pension assets?
Yeah, absolutely. I think, since inception of this industry, there's been opportunities, to invest outside. And trust me, how many of us has even explored that option? I think we want to complain, about, our guideline. And then when the regulator, makes available opportunities, based on our complaint, we find additional, excuses. So like I showed in my presentation, the love, for equities or alternative is born out of science. We have some schemes that are 100% or probably 90% fixed income. Our master trust, currently has about 8% allocations to equities. And we've had, higher allocation to equities, even when the market, was doing terrible. And those predominantly, fixed income securities, they didn't do, so better than us. Thankfully, in the wisdom, of the management of Access, right from inception, we had this segregation that the MPRA recently introduced. So we had higher probably capacity to take risk, knowing very well that those beneficiaries who are nearing, retirement, 50s and above, we could allocate 0% equities to them, and those younger guys, we could allocate higher equities. But if you look at our growth portfolio over the last, 10 years, the result hasn't been terrible vis-a-vis those schemes that are predominantly fixed income, just because we've observed that when equities are terrible, right, the impact on the portfolio that still allocates over 90% to fixed income is low. However, when equities, right, turns around, you see a 3%, 4%, premium over the fixed income driven portfolio. So yes, I get, the whole argument about lack of viable companies on our market. I get the whole argument about lack of opportunities in the private sphere. But the question is, there are few of those in our market, and how have we responded to them? Guess what? MTN, in quote, is struggling to meet the localization, threshold. And we have, pension funds, worth over 25 billion. And these guys have gone around. Are we saying MTN, it's a junk company, it's a terrible company, and therefore we can't invest in MTN? I think, the problem, is lack of appetite for those risky investments. But the science of investment management does not just support, that. And trustees and fund managers will just loosen up and then take, the risk. It pays off, ultimately. For our schemes, 2021 was a good year because of our equity, heavy allocation. This year, equities minus 2%, but we are looking forward, to the interesting dividends we'll be making, across board. Given where valuations are, dividend yield for our choices portfolio, in my view, will be above 10%. 10%, can cancel out negative 5%, 8% with 10, even should markets come down. So that is what drives, our interest. It's not like we like risk, but we feel the numbers, support it.
Nana, I agree with you. Maybe before you come in, that, and the appetite for equities will also probably cause a natural increase in demand that will also help with improvement in the stock market. But I want to find out from the portfolio managers, what is the hesitation to investing in equities? And probably before you come, I think Ms. Shope wants to add a point.
I wanted to lend credence to what Nana just said, because Nigeria's pension system, we've been running like the multi-fund structure for over 3 years now. And even though initially when it started, the aggressive portfolio, the return on the aggressive portfolio wasn't so impressive. But in 2020, when we saw a rally in the equity markets post-COVID, where you had economic, the funds performed every other, the other non-aggressive funds, and the return was enough to cushion the impact of previous years of doldrum or much smaller returns. So in as much, and I mean, even though you may say that Nigeria's market is deeper than what you have in Ghana, there's still that sentiment towards the market is not deep enough. You only have a few good names to invest in. It's pretty much the same across every African country, but that doesn't mean that they're not there. You don't have investable instruments that you can pile into in those markets. I'd also like to say that Africa has like an appetite for the youth population. Has an appetite for risk. I think the work also boils down to pension managers putting together funds and marketing those funds to the right people. We have like a young work population, these people are more risk tolerant than the much older people. So you should probably target, they're the ones investing in cryptocurrencies, as crazy as it seems. So if you can put your money in cryptos, why won't you put your money in viable equity vehicles? So I think the pension managers also have a duty to come up with funds and drive the acceptance of those funds to the target population, which is the youth workforce.
So the pension fund managers.
Sure. Look, we don't have any hesitation. The only problem we have is the availability of the stock. I do agree with Nana. Like MTN for me is one of the companies I'm so passionate about, because I had the chance of working on the transaction, but I'm also invested in it for full disclosure. MTN is unique in the sense that if you look right across the stock exchange, it's your largest telco, effectively your largest bank with its Momo offering, and your largest technology player in the sector. And these are sort of the fastest growing sectors across the world. And you have that in one company. And yet the share price doesn't seem to reflect the strong fundamentals of the company. And so there is something definitely wrong in how the market looks at that particular credit, how we do look at it as fund managers and as an industry as a whole. There are other good companies within the stock exchange that perform well. But as much as I do like to invest in names like that, I think we also have to be true to ourselves in terms of the opportunities that exist. I'm sure most people who are watching us are probably watching us with Zoom or Microsoft. So why aren't we able to buy some of those stocks and those shares? I have a Samsung watch, you probably have an iPhone. We don't have access to those stocks. Those are the names we should be holding. I love the names on the stock exchange, but we're a population of 30 million people. It's very unlikely that we're going to have companies growing, revenues 3 times over in a year. You have these large, global companies that are growing in territories and multiple times, crazy valuations, and we don't have the opportunity to invest in them. The S&P 500 over the last 10 years has made 1,000% return. So $10 million invested, 10 years ago would be worth $100 million now. And I'm saying for pension funds, we would have been able to do $100 million. That would be worth $1 billion to the Ghanaian sort of economy over that period of time. So for me, I feel like there is no hesitation on our side. I think sometimes the way our FX is controlled, etc., makes it difficult for people to take those monies and go and invest outside. Just look at the pension fund allocation. For a few years ago to actually get approval to do that 5%, the process was just ridiculous. It didn't actually make any sense. So we just invested locally. But you can't put all your eggs in one basket, but also nobody is allowing you to be able to go out to make those investments. And so some of the work that we've done is to look at how we can do that in a way that doesn't have a huge impact on FX. And it's something that we've worked on and we actually invested, but we haven't gone publicly with it because we're still working on the way to actually execute it in a very FX efficient way. So for me, there's no hesitation. It's just really a question of whether the environment that has been created allows us to be able to do that in an efficient way.
But Dr. Tracy, let me find out from you, when we begin to look at external investments, like we're talking about, I'm sure there are offshore unit trust or mutual funds that are into equities, like Eric is saying, that pension schemes can't invest in. But what will that be for? What will be the implication for the economy? Should the central bank be worried that pension assets are now beginning to look at external investments?
Yes, I think it is a gray area that needs to be looked critically, because here we are struggling to get funding to the private sector. And I mean, we go on roadshows for FDI and all that. So we need the resources domestically. But the options are also, like Nana indicated, we are only 30 million. So there's always a limit to how stretch we can go. But in terms of investments outside, it's an opportunity that pensions funds can explore. But I think that the regulator would be cautiously optimistic about that. You want, in as much as possible, a very diversified portfolio as possible. But as you go and invest outside, you are also dealing with regulations in terms of how do you repatriate your investment and all that. We are currently dealing with significant depreciation of the currency because there's a lot of repatriation that is happening around this time of the year. So in addition to this, if funds are also running elsewhere, then it might be problematic. But I believe that, yeah, some allowance, 5%, 10% of funds being allowed to go elsewhere, depending, I mean, could also be beneficial in terms of the overall returns that fund managers would make.
Great. I understand there are quite a number of questions on our online. We'll ask Jeffrey to mention some of those questions for our panelists to take. But whilst he gets ready, let me ask this one. The popular e-levy, assuming it comes to pass, what will the implication be for pensions? This is an open question. Anyone? Maybe from the trustee perspective, from the fund manager perspective, and then from the economic perspective.
I think, I mean, basically we have a lot of contributors, right? In our tier 3 contributing via Momo. And we are still, I mean, in the dark whether those contributions, I mean, would attract a 1.5%. So that is a huge concern. And it would be, I mean, a great disincentive to investment. So personal view, I mean, I don't support e-levy.
E-levy will be counterproductive to pensions outcomes.
Extremely counterproductive, yeah.
So I think in recent years, the industry, not so much as pension, fund industry, has made a lot of strides in terms of digitalization. And we've seen a lot of contributions. I can say that our deposits come from some of these channels. And my concern with the introduction of the e-levy is that could potentially be wiped out. It will likely promote a more cash-heavy system, and with traffic and everything coming into play as to whether people will come and make deposits anymore, that is a concern. Privately, my suspicion on e-levy, though, is that is not the end game. The end game could be a securitization of e-levy. And I'll leave it at that.
That's another conversation.
Yes.
So, Moshope and then Dr. Chu. Yes.
I'd like to say that that have implemented e-levies at some point in a bid to try and address their revenue challenges, haven't been so successful in doing that. Nigeria, for instance, has e-levy in place. Nigeria has e-levy in place, and we're still not good in place of fiscals in those. So the levy may not be as successful as the government expects it to be. One of the reasons is because a number of people may decide to do cash deposits instead rather than, so whatever it is they're estimating to realize at the end of the day may not come to fruition. So yeah, it may be some counterproductive in some way. If on the fiscal side, you're not getting the gains which you expect, and then it's probably discouraging pension contributions as well. Then I don't see why it should fly at the end of the day. But what do I know?
Is that
I think they have said it all.
right?
Yeah.
I saw this WhatsApp post. They were talking and they said, "Is either e-levy or e-petrol. You have to choose one." So, Jeffrey, please.
Great, thank you very much. And let me just say that the issue of the e-levy came up a lot in the Q&A session. So it's good that you asked the panelists. So I'm going to start with questions that came in for Doc after your presentation, so that maybe you could. I'll just read out 3 or so questions, then you can take them. And then I'll also come to Nana Riafi for some of the questions that came in whilst you were doing your presentation. And so for Doug, I'll start with the questions for you. This is from Elias Day, and he's saying that, should we be overly worried about debt to GDP, given that countries like Japan has over 230% debt to GDP, Canada has over 83% debt to GDP, and a host of other countries? What is your view on the school of thought that focus should rather be centered on the amount of revenue generated to service these debt? So that's the first question. The second question is coming in from Michael Kweku Owusu. Michael is saying that, what is your recommendation on solving the information asymmetry, and how can it be extended into pricing of loan underwriting in general? Maybe the last one, just to make it 3. I think it's also coming from Michael, and he's saying that, what is your view of suggestions that the Bank of Ghana should impose a cap on loan margins by banks? So those are 3 questions for you, Doc. And then maybe when you are done, we'll go to Nana, and then we'll come back to you.
Okay, thank you very much, Jeff. I think on the issue of about the debt to GDP, for starters, the countries he gave as examples are all developed countries with the capacity to generate huge resources in terms of whatever debts are. The debt to GDP ratio, as I indicated, is not necessarily a problem, but inherent in it is the ability to generate the resources to service the debt, and also what the debt has been used for. If you look at the debt service to total revenue ratio in Ghana, we are doing about 30%. So that means that it's a cost worry that all the resources we are able to generate, more than a third goes into it. And that cannot be sustainable. And that is why we are worried. And as a developing country, the threshold really is you should not go beyond 70%. But that said, the sources of the usage of the funds that are raised is also critical, because if they go into productive sectors that generate resources, then the debts can pay themselves. But indeed, when you look at the data, it doesn't support that, because capital expenditure in Ghana has been going down in recent times. On the issue of solving information asymmetry problem, we know that digitalization, and that is why e-levy, for example, is a cause for concern in the right direction, because if we are able to digitalize, get a great platform where everybody is on, the Ghana card, digital address systems, you can trace people, so that reduces the risks associated with default, because people cannot go under and go elsewhere to go and borrow and default. So that is it. In terms of the cap on loans, it is something that, as we have indicated, maybe is a policy issue, and you do not want to. We have traveled the journey of deregulation, right? So you do not want to roll back the gains we have made with liberalization of the financial sector. But that said, if the market is not responding to the incentives that the central bank is giving, is creating there, and if profit margins are way too high in the Ghanaian situation, then options exist. If the cap, it's way of an extreme, I know that government is talking about the development bank option, like we indicated, where critical funds could be sourced by productive sectors of the economy at a lower rate rather than what is being offered on the commercial rates, really. So those are options that needs to be explored. But indeed, the widespread in the Ghanaian economy in terms of the interest rates is something that we should take a critical look at, because other economies with similar fundamentals do widespread. So that's what Ghana, really.
All right, thank you very much, Doc. I'll move to Nana Wiafi also. I would also read just about 3 questions for you to respond to, and then we'll come back to Doc again. Francis Salom says that, how does the current economic environment affect pension funds and the decisions that you take so far as returns on returns for investors are concerned? That's from Francis. Maxwell is saying that inflation is on the rise and the city is also depreciating very fast against major foreign currencies. The question, he says, is it possible for pension funds to be pegged at the equivalent value of $1 of the day at the amount paid with investment and the amount paid with interest when the investment is redeemed the next time? The third question is from Nanajwa, and she is saying that, what considerations are being made in the area of real estate investment funds? Are they good instruments out there towards pensions, so far as the Ghana context is concerned? So 3 questions for you, Nana.
All right, Jeff, thank you for the question. So I'll take from the bottom, up. So on the question about real estate investment fund, yeah, if you looked at the capital market, table I showed, real estate tends to perform in an inflationary environment. So obviously, having real estate in investment mix is a good thing. But then before, we would enter into real estate, the pricing, right, should be right. Real estate should also be fundamentally, driven. So I will not buy a multi-occupancy apartment in Cantonment for outrageous, dollars, and then make, some small revenue. Also, per the new pension guideline, we cannot do private real estate investment if government is not involved. So I can't carry, money and go and buy a big building just because I want real estate. There's some checks and balances of what present itself, and it makes sense. The fundamentals make sense. Yes, real estate would be a good store for value in an environment like Ghana, where inflation and currency depreciation constantly prevails. My phone went off, so I missed, the second question. I think the second question has to do with dollar, right? Our investment are supposed to be made, in cedis. We can't peg contributions, to dollars, because that would be promising return. We don't go into an investment knowing what the outcomes are. So if I promise you a certain dollar peg and the currency depreciates by like 40%, like it did in 2014, then what do I do? But what we try to do as much as possible is to diversify across more. And that's why Carl mentioned that we are positive on euro bonds, because currently at a yield of 13%, even if the currency, doesn't depreciate, we feel 13% on the dollar, it's a good yield. And that also protects us from further depreciation of the currency. And the first question
has to do with the implications for pension funds so far as the economy is concerned.
No, we just, need to stick to our asset allocation, right? We've gone through worse times in Ghana over the last, 10 years, and we survived. And as has been said by Dr. Presler and Boshofe, the outlook of the economy doesn't look too dire. So there's no need, to panic. What we need to do is to consistently, stick to our asset allocation. Obviously, we live in a country where the government is paying, too much on government of Ghana bonds. 20% average yield, inflation is 30%. There's still some 7% real return. I don't know how bad depreciation will be this year, but I'm sure at the end of the day, there'll be some positive, margin. What we need to do is to keep invested, not to keep monies in cash, because then that drags performance.
Okay, so I'll do a last round with Doc, and I'll come back to you, Nana, again. So Doc, I'll ask you maybe your final 3 sets of questions, and then you can respond to it. The first one is from Francisca, and she's saying that it was a great presentation, but she says that you mentioned that the high cost of banking in Ghana has to do with a few players being able to set prices and or pass the cost to consumers or customers. However, the recent Bank of Ghana the recent banking sector report by the Bank of Ghana mentioned that banks in Ghana wrote off over 2 billion Ghana cedis in bad debt in 2021 alone. And she's saying that to what extent do you believe that high default rate in Ghana impacts the cost of banking and access to credit? So that's from Francisca. The second question is from Samuel. And Samuel is saying that a very insightful and educative presentation. But the question is, how do we contain the high imports? How do we reduce citizens' appetite for foreign goods since it feeds into the high import bills, forex, and the depreciation of the city? That is from Samuel. The last question is from Dorcas. And Dorcas is saying that, Doc, you mentioned that it is important to diversify the tier 2 and 3 funds away from government of Ghana securities as the private sector needs resource for investment. Considering the fact that the constituents fund structured by MPRA in their, and she provides the documents in their type 1 kind of funds, have a chunk of the tier 2 investment in equity markets. Will it not be risky, considering the fact that the performance of the equity market is not stable and has consistently underperformed the fixed income market? Is that not a high risk of losing pension funds? So these are 3 questions for you, Doc. Yeah, you can go ahead. She's mine.
Okay, so on the high cost of banking, meaning that I indicated that banks pass on the high cost of transaction costs onto the consumer. The default rate, the high default rate it's in itself priced in the loan. So it is because of the high default rates and the information asymmetry issues, all the unseens that the bank is facing. That is why it is priced into the loan. But when that is done, then the attraction is because of the information asymmetry, then the loan attracts quote and unquote, the bad ones, people who are likely to default. Because really, if you are going for a loan at a rate of 22%, then depending on the investment venture you are moving into, it's a very high risk. So it's more of like a cycle that keeps moving on, and it has to break. And how will that come out? We know that with digitalization and solving some of the problems with information asymmetry, then the high non-performing loans and the bad debts of banks could come down, could potentially come down. So that is that. In terms of how to curb appetite for imports and solve the problem of depreciation of the cedi, it's more of a moral suasion issue, and also for us to get to work on our industrialization agenda. Produce import substitutes. Some of the imports that come to Ghana, sometimes you wonder, we are importing fruit juice. We even import water, imported water and all that. All these put undue pressure on the currency. So our industrialization agenda, producing import substitutes by being intentional in supporting those manufacturing activities to substitute and rather concentrate on imports of important items that we do not have the advantage to produce locally, is something that we need to look at critically. But it's more of a moral suasion issue, that when the Ghanaian goes to the supermarket, make a conscious effort to pick something that is Ghana made, because for any imported commodity you consume, you are creating jobs for other people and putting pressure on the currency. With the risks with equity markets, I believe that with regards to pensions, we are talking about the need for diversification, because it appears that over 80% of the funds is going to government securities and all that. So yes, there is risk that comes with the equity market. And Nana has rightfully indicated the gains that are also there when it is done cautiously. So it is more of getting a good blend, some minimum risky assets here and there with a blend of safe assets. And I believe that that will be.
Okay, thank you very much. The last round, I think we'll go to Mosope, please.
Okay, just to add to what to Dr. Priscilla's last commentary, should also, aside moral suasion, we should also be looking at adding value to our exports. I must say that the few times I've been in Ghana, I was impressed to eat chocolate made in Ghana, which is actually good, because rather than focusing on exporting raw cocoa beans, it's undergoing some form of transformation, adding value to the cocoa beans, so you're able to earn more in foreign exchange from the sale. So I think the focus more should be on identifying markets within Africa, since we have the AFCFTA, identifying markets within Africa where such products would be a big hit, and capitalizing on the AFCFTA to drive the export of those products.
Great. Thank you very much. I'll ask Nana the last set of questions, and maybe I'll come back to you, KB. So Nana, the next set of questions for you is that this is from Jacqueline. Jacqueline is asking, is there any law that protects our funds in case of an emergency? And she's given an example that, for example, emergencies happen in the case of Gold Coast Securities and the like.
Can I take it one by one?
Okay, please.
So yes, it's in the MPR guidelines. There are so many investments we are not allowed to do. So for instance, pension funds cannot do any investment below a tier 1 bank. We can't do savings and loan. And that is why almost 100% of pension funds, were protected from this men's gold, debacle. So yes, there are quite some laws that protect us from taking foolish risk with your money.
Okay. Nanajwa is asking, As an investor, I struggle to find information on alternative investment instruments. Beyond the traditional fixed securities, how do we find other opportunities to invest in aside what the funds do?
So really, alternatives, are for institutional, money, because the admittance, rate to invest in institutional is high. Do you have $1 million to invest in private equity? Obviously, I don't know, your pocket, but then it's likely, no. And even if you had it, you will not expose 1 million to a single fund manager. So alternatives are really a foray of institutional money managers. Like I said, there's this, new gold ETF. So if you are an investor in Ghana, a retail investor, you are concerned about currency and you want some protection because we know gold plays, that role in an individual's asset allocation, you can explore that new gold, which is listed on the stock exchange. Just speak to your broker and your broker would advise you on what to do. Yeah.
Okay. That'll be it.
Thank you.
I don't know. So we'll come back to KB.
Yeah, so I guess, Nana, not to let you go, the new guidelines for kindly with the pension schemes have more like a one size fits all, where all, irrespective of your age, you are grouped together in an asset allocation is done for you. In the new guidelines, the authorities proposing the constituent funds, where you have 15 to 45 or 44 years in one, then you have the 45 to 54 in another group, and then you have the 55 to 60 years in also one group, and they have different asset allocations for these constituent funds. My question is, do you believe this will change?
I think you need to rephrase your question.
Okay.
We want
right.
So,
Hello.
So currently, with the pension schemes that we have, it's one size fits all. Irrespective of your age, you are in one group of an investment and with different asset allocations. In the new guidelines, the authority is saying that all those aged between 15 and 44 should be grouped into one category. And then you have 45 to 54 in one group. And then you also have the 55 to 60 years in one group. These groups will have different asset allocations or mandates and approach to how we invest their funds. From where you sit, do you think that this would improve the outcomes of these beneficiaries if we adopt this approach?
Yes, I think so. So, rightly so, for those below the ages of 44, you are mapped into a moderately aggressive portfolio that has between, I think, 10% to 20% in equities. And the logic, is for, those young members, they're able to ride out volatilities that comes with investing in risky assets like equities and private equities. So 1 or 2 or 3, bad years does not wipe out their retirement, outlook, because obviously, the market will compensate you with a 44% like we saw, last year. So I think it would generally, improve pension outcome, for our members. And I hope, all trustees and schemes, would embrace, this new constituent fund, structure. Yeah.
And there's a fourth one, which the authority says is voluntary, where you have about 20 to 60% in variable income. That includes investment in shares, investment in alternatives, investment in offshore products or external investment. For Eric and then me, on the fund manager side, how do you position this fund to make it attractive to members to be able to select this fourth fund? How would you position this fund to make it attractive to let investors opt to join this fund rather than go on the life cycle one?
So I think even, I mean, one of the disclaimers that often accompanies marketing promotions is that historical performance is not necessarily a guarantee for future performance. But chances are that my first step would be to likely rely heavily on that data to demonstrate that those aggressive portfolios, I mean, given a considerable amount of time, tend to outperform other asset classes. Just need time and patience to execute that. It may be slightly difficult for an MPRA license scheme to execute, because I remember in this very room at the last one, there was a presentation that outlined that the Ghanaian market, as well as other frontier markets, over the duration of the implementation of the MPRA license, the MPRA regime, have tended to outperform. But to Nanayafi's point, if you do the asset allocation well from a security selection perspective, there could be hope for an outperformance.
So, I mean, I mean, Nee has covered that well, but I think in terms of a lot of the things we've spoken about here on the investment side, I still think, we keep talking about equities as risky, and that creates an impression that, yeah, it is risky, but within the context of a return perspective. So you can't just look at one side. So to Nee's point, if you have, or you give an investment a long enough time horizon, there's a good chance that, that's why I mentioned the S&P 500, but there are several other. There's 500 companies in there. So one ETF, spider ETF of an S&P 500 essentially has, 500 companies in there. I don't know what other diversification you can get in one sort of instrument. But I also think the concept about marking to market is very, very important, because when people make comparisons between equities and fixed income coupons don't change, but the prices of bonds do change. And I think until we get into a regime where bonds and portfolios are being marked to market correctly, people won't be able to see the alpha or the value add that is brought. So somebody always posts a performance of 20% because they never mark to market. But in one day, when let's say the market really turns and you have to liquidate a portfolio, those who are able to exit out of the portfolio first will be the ones who take all the money out. And those who are stuck there, who are trying to get out, will be a huge problem. So when you talk about this for fund, it's really important that in terms of how we mark the portfolio, it has to be on a mark to market basis, so that when people are exiting, everybody exits at the same price. When you don't mark to market and there is a run on the fund or people want to exit, it's usually those who are stuck in there who would suffer. So I think that's one thing that they really have to look at in terms of pricing of the funds.
Great. So I guess the fourth fund will be marketed aggressively by the trustees to ensure that members improve their outcomes on the pensions. The last question before we take our final remarks. New guidelines puts a lot of emphasis on alternatives, and two key areas of interest is project finance and then direct investment in real estate. However, there's a clause that says that there must be government or quasi-government participation. My question is, will this clause improve the outcomes of pensions, or it's actually a disincentive to we seeing alternatives in the pension space? Maybe I'll start with you, Eric.
I shook my head, and I don't think so at all. Look, if you look at the types of projects that governments do in terms of real estate or infrastructure, it's mostly projects that have a longer term social benefit, which doesn't actually even sometimes marry with what a pension fund, which probably has a 10-year horizon, is looking at. So governments have much longer sort of objectives compared to where we are. So for example, we've had a whole long conversation about should we be buying dollars, etc. I think what we should be doing, again, I think tourism is low-hanging fruit. Mount Afajato doesn't have anything on top of it. Something can be done there. Lake Busumtree could be the biggest sort of Paradise Lake where you can go and have a resort. Mole Park should import some rhinos, something, giraffes. I mean, there's so much more we can do to import, the currencies that are really stable into our economy for us to invest in. That money, when we talk about real estate, that's where pension funds should be putting their money. If you look at the hospitality sector, almost every December, I think for the last few years, there's not a single place that is empty. I mean, occupancy rates are through the roof for hotels, etc. Governments are not in the business of going into hospitality. So why would you sort of force pension funds to invest with a government? Doesn't really make sense to me. There are several residential, commercial, hospitality type infrastructure projects that make a lot of money, but that don't involve government. So again, you're skewing what pension funds can do towards a sector that is not geared towards making profit. So I have an issue with that, and I think hopefully, it should be addressed at some point in time. But I don't actually think it helps us as pension funds.
Eric, I absolutely, agree with you. But that nonetheless, we should still, look out for the opportunities. I don't know whether, per the guideline, we could have participated in the Terminal 3, airport, or the Gapaha, expansion. I don't know what the numbers of that particular project is. But then this, in my view, from where I sit, devoid of corruption, overpricing, and all those things, we know our government, get, involved in, present a very opportunity, for significant gains, right, for pension, funds. So yes, what they have in the guideline is a disincentive, absolutely. But then we should still, keep, our ears and eye for opportunities that comes within, that space that would generate significant, returns for our schemes. Of course, we are not snakes. We will not, do any public library or book home boxing, arena. So if the project doesn't, make financial sense, no. But all right.
Right. In the interest of time. So thank you very much, my panelists. But before I release you, in one sentence, in all the conversations we have had, what will you say will improve the outcomes of pensions? We'll start with Dr. Twumasi and then come all the way down. In one sentence, what would you say will improve pension outcomes?
I would say diversification is a way to go.
Diversification. Great. Nana?
I would say keeping to the ethics, of the game.
Keeping to the ethics.
I think there's a yin and a yang to all the arguments. So while we think about return, we should bear in mind that everything comes with a risk.
Return and risk.
I think targeting youth and educating them on more viable products that may come up from this new NPRA guidelines would be a good way to go.
Our youth should look more at risky investments.
Exactly.
And get more.
Exactly.
I think the emergence of this new digital economy presents far more opportunities than we've probably seen in the last 100 years. And I think that we're at the dawn of that. And I'm expecting that to sort of carry us forward. So again, names like MTN, your telcos, your digital players in the fintech space now look relatively small, but they will be the leaders of the future. And hopefully with the new guidelines, etc., we'll be able to make investments towards such types of entities. And that hopefully improves the outcomes overall.
Great. Thank you very much, panelists. And thank you, audience, for staying with us. Back to you, Jeffrey.
Thank you very much. Please for Kelly and the team. Mr. Kwabena Bauama, our moderator, is the Managing Director, Stanbic Investment Management Services. Nanayo Afibwama is Chief Investment Officer, Access Pension. Dr. Priscilla Twumasi Boafo is a Senior Lecturer at the Economics Department, University of Ghana. Nia Mpasoa is an Associate Director, Beta Bank Management Asset Services. And Eric Appiah is Managing Partner, Black Star Advisors. Moshope Arubia is Economist with the IC Group. Please let's put our hands together for them one more time. We do appreciate your time and your presence. Thank you very much for the insightful conversation. So, ladies and gentlemen, what we are going to do is we are slowly coming to the end of our conference for this year. We would like to receive a closing remarks, and the closing remarks will be given by none other than a regulator or representative of the regulator. He is the Director for Planning, Research, Monitoring, and Evaluation at the National Pension Regulatory Authority, NPRA, and he's in the person of Mr. Ernest Amate Bondi. He's joining us online, and so Mr. Bondi, if you are online, kindly activate your camera and microphone, and then we will take the closing remarks from. Hello, sir. We can see you live and clear.
Okay. Good afternoon, everyone. First of all, let me say thank you to Axis Pension Trusts for the invitation extended to the National Pensions Regulatory Authority to make the closing remarks to this conference. The Chief Executive Officer of the National Pensions Regulatory Authority has been excited all along to address this conference, but he has been called into an emergency about 3 hours ago. So he has requested me to read his address to the conference. We apologize for that. So I'll read his address on his behalf, with your permission. My role in MPRA is serving as the Director of Planning, Research, Monitoring, and Evaluation. So the address. Closing remarks by the Chief Executive Officer of the National Pensions Regulatory Authority at the Axis Pension Strategy Conference 2022. Mr. Chairman, Board of Directors, management and staff of Axis Pension Trusts, resource persons of the conference, invited participants, distinguished ladies and gentlemen. I wish to thank you for the invitation to speak at your 2022 conference and to give the closing remarks. This effort at knowledge sharing and knowledge promotion is a laudable effort worthy of commendation. Indeed, we at the Regulator's Office recognize and appreciate the significant role Axis has played and continues to play in the pensions industry in Ghana. We highly praise your efforts at that. Economic security in old age is an integral part of every individual's well-being, and pensions are intended to offer people this security once the worker or employee can no longer earn their living themselves. Pension schemes have now become a modern mechanism to provide retirement income to the aged for the maintenance of their standard of living. It is a financial security system for the welfare of the aged, with its core objectives being poverty relief and insurance. In other words, pensions provide protection to people to prevent them from falling into poverty at the end of their working life. Since it is a fact that today's worker becomes tomorrow's pensioner, matters to do with pensions and retirement are of immense interest to the Regulator's Office. We take note that the COVID-19 outbreak that began its spread worldwide from the early parts of the year 2020 has triggered a global health crisis. It has led to business disruptions everywhere and in all sectors, including the pensions industry. This has prompted an economic and financial crisis worldwide, and various countries have introduced preventive health measures to curb the spread of the virus. Economic activity has slowed down across the globe. This impact has the possibility to lead to lower incomes in retirement and dysfunctions in the pension industry. And relevant measures are being thought through to mitigate the effects of this pandemic. Ghana's pensions reform implementation is over a decade old. The relevance of the reform has been influenced by the need for diversification of the sources for retirement income provision and enhancement of retirement income. To focus more directly on the topic for which you requested the MPRA's remarks, I will say that over the years, we have had a fundamental challenge in our operations of our schemes, an assumption that the risk tolerance and returns expectations are uniform across the entire membership of schemes. This underlying assumption has led to the creation of pension schemes with divergent membership having divergent views in terms of risks and rewards. A scheme member's investment horizon may differ individually within a range of 45 years. That is when it starts saving at 15 years old to as short as 1 month on the other end of the spectrum during the brink of retirement. If we are to assess scheme members' investment horizon to their individual risk appetites, we may deduce a natural convergence or similarities in their risk profiles. Therefore, a prudential categorization of such risk profiles into constituent funds becomes rational. The National Pensions Regulatory Authority issued its first guidelines on investment of pension scheme funds in 2011. And this was subsequently amended in the year 2017 and then in year 2021 to reflect the dynamism associated with pension fund investments. The new investment guideline leverages on the foresightedness and provisions made in regulations 11 and 22 of LI 1990, which is the regulation that accompanies the National Pensions Act, by introducing constituent funds in order to rectify the challenges aforementioned. The key objectives of introducing these constituent funds are three: liquidity, risks, and profitability. Mr. Chairman, liquidity to ensure investment maturity are in congruence with scheme members' retirement timelines for efficient assets and liability management. Risks to have a diversified portfolio that will suitably match risk appetite of scheme members, and ability to achieve optimal profitability by exploiting investment avenues for much safer returns. Mr. Chairman, we have expanded on the permissible alternative investment asset class to include project finance, direct investment in real estate, private debt funds, and infrastructure finance. Additionally, segregation of schemes into constituent funds based on age profile and risk appetites. For Tier 2 or occupational pension schemes, by default, membership from ages 15 to 44 are placed in Fund 1, labeled as a moderately aggressive portfolio. People in the category age 45 to 54 into Fund 2, labeled as moderately conservative, and age 55 to 60 in Fund 3, seen as a conservative portfolio. A formal request may be made for an aggressive portfolio, which is labeled Fund 4. For Tier 3, or Provident Fund and personal pension schemes, trustees shall structure the appropriate constituent funds to meet the different investment objectives, liquidity, risk tolerance, and rules of the scheme. Mr. Chairman, an extract from the new guidelines are as follows. Fund 1 shall have a minimum of 15% of assets under management and a maximum of 45% in variable income instruments. Fund 2 shall have a minimum of 5% of assets under management and a maximum of 20% in variable income instruments. In addition, allocation to Government of Ghana Securities shall be a minimum of 40% of assets under management. Fund 3 shall have a minimum of 60% of assets under management in Government of Ghana Securities, with no allocation to variable income instruments. The maximum limit on Government of Ghana Securities allocation shall not apply under Fund 3. Fund 4 shall have a minimum of 20% of assets under management and a maximum of 60% in variable income instruments. Investment policies for the defined constituent funds should develop and implement strategic and tactical asset allocations considering changing liabilities and prevailing market conditions. To conclude, Mr. Chairman, as a regulator, we are evolving to improve upon conditions based on current knowledge and emerging trends. Our efforts are required to achieve the needed results. The MPRA appreciates the need to work in close cooperation with key stakeholders of the pensions industry to mobilize and invest contributions of persons in active employment in order to ensure a secured income as they retire. With more than 200 pension schemes managing assets valued at over 28 billion Ghana cedis, we should be circumspect and learn from the experience of others as well. However, the fact still remains that in Ghana, our pensions should be tailor-made to suit our needs. Mr. Chairman, thank you for your attention. I'm done. Thank you.
Thank you very much. Please let's put our hands together for the Director for NPRA responsible for monitoring, evaluation, and research, Mr. Amate Vondi, on behalf of the Chief Executive Officer at the National Pension Regulatory Authority. Ladies and gentlemen, we've come to the end of our conference, and we would like to take a few announcements before we go. Actually, there are a few questions that the next person I'll call on would have to respond to before he gives any other announcement. And so I'm going to read out the question as he approaches me. The first one is saying, please, can you kindly explain why withdrawals goes against you? And this is from Joyce. And she says she's not clear about why withdrawals would go against her. The next question is saying that after 10 years, who determines the percentage of contributors? Who determines the percentage the contributor can withdraw from the Provident Fund, assuming the employer is not ready to allow employees to take any percentage of their contribution on behalf of the employer? I'd like to invite the General Manager here at Access Pension Trust, Pa Kofi Ankoma, to respond to it. Thank you. A round of applause for him, please.
Thank you very much, Jeff. And thank you for joining this year's strategy conference. I'm actually still impressed. We have quite a number of you still on the call. We are indeed grateful for engaging us during this period. To answer the questions that Jeff just raised, why do you want to stay invested? Is it for, instead of withdrawing? Is that a question? Good. So I think when during the presentations, we heard something about debt to GDP ratio. In pensions as well, we have something we call income replacement ratio. Ideally, you should be targeting about 60 to 70% of your pre-retirement income. Now, if you just take your tier 1 and tier 2, that's the SNIT scheme and your mandatory schemes, you are very lucky, you'll be very lucky to get close to even 50%. So if you are privileged to be in an organization that has a tier 3 scheme, my advice to you is that it is there to augment what you already have under the mandatory schemes. So the question then again comes back to you. Why then do you want to deplete an already existing deficit in your retirement outcomes? So I would discourage you from withdrawing and encourage you, keep your money invested. The longer you stay invested, the better for you and the better for your retirement outcomes. The second question is, who determines the rules when I'm withdrawing after 10 years? Is that my employer? In fact, the pensions law doesn't say you should hold your money for 10 years. The pensions law gives you the right to withdraw. If you are contributing to a tier 3 scheme, you can withdraw after making the contribution, either the first year, the 10th year, the 20th year. The only justification for the 10-year anniversary is that you will not pay any taxes. So for the taxes that are applicable for early withdrawals, you are exempted from paying those taxes. However, withdrawal from any employer facilitated scheme like the Tier 3 Provident Fund or End of Service Benefit Scheme is based on the rules that established the scheme. So if you have a scheme that says that you should keep your money invested till you leave because an End of Service Benefit Scheme, definitely you would have to take it only when you are leaving. If your rule says you can withdraw from it after 2 years of contributing, definitely you can withdraw. But if any of these withdrawals are earlier than the 10th anniversary of your first contribution, you are subject to pay taxes. Of course, only if you are not if you are withdrawing away from retirement. If you are withdrawing from retirement, you are not paying any taxes. So that would be my answer to you. Now to my subject of being here. I'm sure a lot of you have received text messages, emails from Access introducing our USSD platform. So I'm happy to once again introduce our USSD platform to you. You can dial *1860#, register for the service and interact with us. You can check your balance, whatever information. I think during the session, some people were asking that, how do I know what is happening on my account? You can use the *1860# platform. It's available on MTN and Vodafone only. You should be able to register and start checking and accessing your statements. This platform has also been, replicated on our WhatsApp chatbot. We call her Afrakoma. Afrakoma is a very beautiful lady. She's available 24/7 to assist you, but her only condition is that you don't call her. Her phone number is 026-1860-000. Let me take that again. 026-1860-000. Add Afrakoma, say hello or hi to her. She's available to assist you with all your pension needs, even if you want to start a personal pension account. I've seen some people asking, how can I do something more for myself? Indeed, just speak to Afrakoma. Afrakoma will be available to help you. You could also download our mobile app or go on our online portal. I think the team will share that in the chat area for those of you who do not have it. On that note, you could also call us, actually, sorry, before I leave, you could call us on 0800 00 1860. Let me take that again, 0800 00 1860. This is a toll-free number for MTN callers only. You call us, we will be available to assist you. Thank you once again, and let me hand over to Jeff to take us through.
Thank you very much, Pa Kofi. Please let's put our hands together for Pa Kofi and Koma here at Access Pension Trust. So also soon come to the end of our conference for this year is the fourth edition of the Pension Strategy Conference brought to you by Access Pension Trust in collaboration with the CFA Society of Ghana. We'd like to take a closing prayer. And so I'm happy to invite the Chief Finance Officer here at Access, Mr. Matthew. Mr. Matthew.
Great. God bless our homeland Ghana and make our nation great and strong. Amen. Now, shall we pray and close? Father, once again, we want to thank you. At the beginning, we sought your guidance and leadership for our program. And we are happy you've been with us, been with our resource people, personnel to translate knowledge that we all need. We pray that the ideas that have been circulated around will be a blessing to pension practitioners, policymakers, and ultimately to the pension beneficiaries. I pray for traveling mercies back to where we all came from. At the end of the day, we shall remember to give you thanks. In Jesus' name we pray. Amen.
Amen. Thank you very much. Please, round of applause for the Access Pension Trust. Ladies and gentlemen, we want to finally, before we depart online, we want to build a community of friends and networks. And so if there's anybody online who wants to share positive testimony or give your expression of your experience so far as our pensions conference is concerned, you can kindly put up your hands. I'll call you and then we'll activate your camera and your microphone, and you can share your experience that you've had with us in the last 4 years. If there's anybody who has been with us in the last 4 years and you want to share an opinion, please put your hands up. We would activate your microphone and your camera, and then you can share experience. Is there anybody with a hand up so I can call out? Yes, please go ahead.
Yeah. Okay, so
please go ahead, Alfred. So Alfred,
yes,
please activate your camera and you can share an experience or anything you might have with us.
Okay, so my name is Alfred Ampa, Plant Manager of Plot Enterprise Ghana Limited, located in Takrady. I've been with Access since I've been in plots for almost a decade. Yes.
Activate your camera.
My camera, I don't see the camera here.
Oh, right.
I don't see the camera here, so let's.
Yes, Alfred, please go ahead.
Okay, so
Alfred, you can go ahead and speak. We can hear you.
Okay, I think now my camera is activated now.
Sure.
Okay, so yeah, so my name is Alfred Ampa. I've been in Plots Enterprise for almost a decade, and I am a member of the trust. And I just want to take this opportunity to congratulate the leadership of Axis. I think you've been doing so well, especially your easy access to your for information. I've even asked my wife to join. So I just want to take this forum to congratulate you for the good work that you are doing. And this presentation will also be very awesome. I've been through right from the start, and I think it's a good thing. And maybe if you could have periodic such that is mainly geared towards, I mean, there was a lot of information about the nation, even beyond Africa, which is good. But I think this is quite deep for some people. So I'm sure people will be interested in something that is specifically geared towards the fund. So if from time to time could have a session, maybe 30 minutes that people can actually ask questions and can have some more information. I think that will add to what you are so wanting. So great. Thank you very much. I really enjoyed myself. Thanks.
Okay, thank you very much, Alfred. We are very grateful for the feedback, and we will do that as you've suggested. I don't know if there's anybody else who wants to share an experience from the last 2 or 3 pension conference that we've had. You can kindly put up your hands, and we'll activate your microphone and camera. Is there anybody's hand up on your side, your production team? Mohammed, if you can kindly activate your camera and your microphone, you can share an experience.
Good afternoon. Good afternoon.
Mohammed, we can hear you. Good afternoon. Please go ahead. We can hear you, Mohammed. Okay. If there's anybody else, I think we dropped. Mohammed is gone off. If anybody, put up your hand and then I'll call your name and you will activate your microphone. Mohammed, if you can activate your camera, I think that would be great. Yeah.
Yeah, good afternoon.
After Mohammed. Go ahead. You can speak. Please go ahead.
Good afternoon.
Mohammed, please go ahead. We can hear you. Hello, Mohammed. Joseph Kujo, if you are.
Good afternoon. My name is Monguneba. I'm at the start of the program till the end of the program.
Joseph, we can hear you. Joseph, if you can activate your microphone and your camera.
Okay, please, good afternoon.
We can hear you. Hello. All right, so I think we are having a bit of a challenge on the activating cameras and microphones. So we would thank you very much, and then we'll organize it maybe in our next conference. Thank you very much for joining and for making time to. God bless you. Bye-bye.
Oh, shit.
Hello. Hello.
Hello.
Hello, this is just a general announcement to our speakers and everybody here.